This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. You never know on X, formerly Twitter, what people will like, what will attract them, what will gain their interest. I usually just post things that I think are interesting to me. Sometimes it works, sometimes it doesn't. 2 days ago, I posted a screenshot from a 1976 article called Prince of the Pits. I think that's what it's called. Pitts is in the title, Prince is in the title. I'm not sure the exact phrasing. It was about Richard Dennis, who's featured in the Market Wizards books, featured in many other books. The famed trader, the famed father of the turtle traders. And I just took a screenshot of something in the article that he said around age 26. So in the article, he's asked to describe the personality of a successful trader. Dennis replies, quote, "He should understand that people have a tendency to self-destruct, and that's probably the single most pressing problem in trading, not to destroy yourself. I think it's far more important to know what Freud thinks about death wishes than what Milton Friedman thinks about deficit spending," end quote. Now, what's so cool about that is that there might be some people that are Milton Friedman fans that immediately think, I'm not on Richard Dennis's side. But Dennis, even though he was highly political, is not making a political point here. He's making a point about human psychology. He's making a point about what's important in trading success. And I know of no trading system, no trading analysis, no trading education that centers around Milton Friedman's views about deficit spending. Zero, none, it doesn't exist. Anyways, that little excerpt that I posted, a screenshot, people liked it. I mean, sometimes it's something that's simple that grabs us and says to us, this is life, this is truth, this is what is real. And that's what a guy like Richard Dennis could do. For all of his faults, for all of his mistakes, the things that went wrong, that guy was fucking brilliant. And in the spirit of that, I'd like to do a little jump back to my archives today and present the last 3 interviews that I've done with the most successful of all of Richard Dennis's students, the turtle traders, the most successful, Jerry Parker. So sit back and binge on 3 episodes, back to back to back. I hope you enjoy. In the spirit of the turtles today, here we are in the first third of January 2024. Who the hell knows what's going to happen next? But if you don't know what's going to happen next, I guarantee you what you will hear next will prepare you for what will happen next. That is, if you've got a pulse, if you're still alive, if you haven't had a frontal lobotomy, if you're not a moron, and if you are not any of those things, what you hear next will set you in motion to make a shit pot of money. Can I promise you that you're going to make an exact amount of money? No. But if you can't figure out from what you're going to hear next is how the world works, how markets work, how trading works, you're screwed. Just give up. Okay, let me stop rambling. I hope you enjoy the back to back to back Jerry Parker episodes. My guest today is Jerry Parker. Jerry is one of the original turtle traders, trained by Richard Dennis and Bill Eckhart back in the day. He has a 40-year track record in the trend following world. That is quite an amazing run. Jerry's been on this podcast many times. He was episode 1000 and he was many other episodes that I forget, but he's been on this podcast a handful of times. Today we cover all kinds of territory, all kinds of nuance, interesting nuggets. Jerry is always a great conversation, and he is fast becoming one of the most popular trend-following personalities out there. He's got a new podcast you can check out as well, and also a new ETF. So stay tuned in this episode for more information on that. Without any further delay from me, let's jump right into Jerry Parker. How's life?
Fantastic. Joined the Memorial Day weekend. Been nice up here. I'm in New York today. Back in Florida tomorrow night.
I got to commend you. Maybe I said this the last time we talked, but I think you've ramped it up even more from this rather shy guy that I met for the first time in the 1990s to now freaking media personality everywhere.
Well, everyone's doing a lot of this podcasting, and it's so easy in Twitter Spaces and Clubhouse, but you have a big lead on all of us. And congratulations on your Mulvaney. That was fun.
Yeah, he's great.
I was halfway through listening to Robert Carver. He's pretty interesting as well.
I've done these wandering in the wilderness, non-trading episodes. Now I think, okay, I'm being pushed. I have to come back and do more trading episodes. I've come full circle, to be honest with you. I was thinking about this today. I've had some interesting guests from different walks of life that were right up there with some of the trading guests. But at the end of the day, the trading guests, you included, there's just something simple and real and natural and honest about the conversation. And that's rare with other guests, I find.
Yeah, you learn a lot from these traders too. I always tell people my favorite books are those Market Wizards, but just trader interviews. They're so much fun. And just let the trader or the smart person talk. You just learn so much.
Yeah, absolutely. I mean, you mentioned those two episodes most recently with Paul and Robert, and it's so easy. Except Paul's, I wish you could see some of the video. Maybe I'll ask him if I can share some of the clips. I would ask these long questions, and he would just be like, Joe Friday, no, yes. It was great. It was great. Hey, I got to share with you before we jump in. I had no UVA connection forever, but I finally have one now. My nephew is down there. He is finishing his freshman year on the football team.
Awesome.
Apparently, the real nickname is White Chocolate. He is a cornerback, apparently the only white chocolate cornerback in the ACC, and apparently the kid's the second fastest kid on the team. That's pretty funny. We'll see what happens.
That is amazing.
I don't think I can give credit to my sister. It must be my brother-in-law that gave him the wheels. So he got a pick 6 in the spring game. That's a big deal.
Gracious. So what are your plans? You visit every now and then.
I typically come in every year, usually around Christmas, but I'm probably going to try to come into Charlottesville. I'm thinking September.
Definitely. I gave up my football suite. That was a bummer. I had that suite for maybe 15, 20 years, but my kids don't go. They live in Richmond, and two of them live there. They don't want to go to football games, and I live in Florida. So I was averaging about one a year, but it's a great atmosphere. Great school, of course.
I don't think my nephew yet fully understands the numbers of traders associated with UVA. It's quite extensive.
Right.
If that's a career that he wants to pursue in the future, there's a lot of doors he can knock on.
One of the greatest events I ever went to was right after 2008. I may have told you this story. There was a panel discussion with Paul Jones, Julian Robertson, Lee Ainsley, and John Griffin. Paul was talking a little bit about the 200-day moving average and challenging those fundamental guys, Ainsley and Griffin. And then they were like, oh, yeah, we don't really pay much attention to that stuff. And Julian Robertson goes, whoa, wait a second. I think I've come around on this 200-day moving average trend stuff. And I was just like, we got to get up and leave right now. It's not going to get any better than that.
That collection of folks associated with Mr. Robertson, they've had some interesting swings over the years. A lot of money's been made, but it's an interesting cast of characters with a lot of different strategies. It's nothing like the commonality that you might find in trend following practitioners.
I mean, just think if we would have been welcomed with open arms. You lose money? That's okay. You're a smart guy. You're Julian Robertson. Here's more money. We had the exact opposite, fighting and clawing and scratching for everything, even though it was much more transparent, systematic. diversified, almost impossible to lose all your money, have a massive drawdown. Yeah, just two different ways the world treats people. Even today, that one guy, Chase Coleman, I mean, he's still managing billions and being respected. And it's kind of unfair, but it will certainly always, regardless, as it's so little to do with money and AUM, be so thankful that I answered a Richard Dennis ad versus Julian Robertson ad.
I'm so thankful I picked up a magazine ad 10 years after you picked up something and read about you. That's kind of how it goes, though. You know, I think that seems to be the way people keep learning from other people. They keep being inspired from other people. I think maybe that's part of the deal. You were just talking about things being unfair. I don't know that this is necessarily unfair, but I've noticed there's a recent article, I think it was recent, blaming trend followers for March of 2020 moves. And then there was, you posted, I saw recently, blaming trend followers, I guess most recently, somehow or another, because China is not recovering, it was trend followers' fault.
We are long stocks or short bonds, of course, because that's where the trend is. So it's easy to pick up our positions.
Do you interpret some of these articles? I mean, I've probably seen every trend following article since the late 80s. It seems like there's not many that I can recall that were any good. And they usually always didn't seem to understand trend following all that well. And they always seem to have this angle that they wanted to blame. Either trend following was dead, or if trend following was doing well, they were bad guys. It's kind of one or the other.
It's funny you mentioned trend following is dead. You know, Moritz Seibert.
Yeah, he came on the show.
Yeah, he's a great guy. He started a new fund, and he named the fund after some bird that I can't even pronounce the bird, Takahi or something. Anyway, supposedly this bird was declared to be dead because nobody had seen it in a long time. And then all of a sudden they saw it. So it wasn't dead. So that's what he named his fund after a bird who everybody thought was dead. I thought that was pretty cool.
I asked a question kind of like that to Paul. He had a 4-year stretch there where it's basically like 1% a year or something. And his answer was just like, whatever, things happen. I don't know. It's the system.
Yeah, the one thing he said that was a little disturbing, Richard, he's on my Twitter Spaces, and he's one of my best friends. He's my second Richard. He's just a superstar guy. And he helped me kind of see a deeper level of trend following, listening to him. He's super good in math. And I asked him about this, but I didn't understand, and I didn't really understand or agree with Paul on this idea that eventually, if you just trade long enough, eventually trend followers, or him in particular, or all of us will eventually lose all of our money. We will eventually blow out. It's just a matter of time.
You think it was a little facetious or just trying to make a point? I don't know if he really believes that.
Yeah, I think he does, but I don't think he needs to explain it better. One of the things that Rich did when we first got there, they would say, what do you think the risk of ruin is? People try to come up with a low number, but they were like, no, that's way too high. 1% or 0.5% is way too high. You've got to make it way, way less than that. And they said the way we do it is when you get in these losing streaks, you reduce your positions and your leverage by twice as much as your drawdown. Remember that turtle rule? And there were some other money management ideas that don't get a lot of press, trade level calculations and things like that. You don't make your trade level calculation equal your assets under management, which was what everyone else does. But in 1983, we were told, no, you don't do that. There's a few little nuances that I think maybe if people don't know about them, they could logically assume that, yeah, you could get into a huge losing streak, especially someone like Paul, who just uses such huge leverage.
You mentioned Paul Jones at a UVA panel that you were on years ago. If I recall correctly, I believe your other Rich Dennis, was his inspiration to get into trading.
Yeah, probably. I mean, it's amazing how so many people heard about Rich and loved Rich and instantly saw something special there. He was that type of guy, just incredibly friendly, nice, and smart.
So crazy that, at the age that you got going, because you're still a relatively young guy. And how many years have you been at trend following?
40 at the end of this year. Turtle program, December 83. 1984 was the first year. And I feel like I should have done a lot better. I knew almost everything I needed to know. Everybody's drifting towards or away from the ultimate truth would be much better to. I have some relatives who don't know anything about math or trading, and they ask me, "How do you trade?" I show them how to trade, and the guys who don't know anything and no interest, they just always follow the rules. To some degree, the smarter you get, it becomes the enemy of just following the trend following rules.
I noticed on your Twitter too, you've added some adjectives to trend following plus nothing. I think if I'm quoting you correctly, I think it's religious, traditional, classic trend following plus nothing. What else can we add? Is there some more that we can add on to that?
Now, I take great pride in that Twitter bio there. All of these things that are up there, they are things I have copied from rude tweets. So one day someone said I was religious. So I put that on there. I've had to take things off. They limit the amount of stuff. Rob Carver is responsible for ideologically pure, meaningless labels. It's got to go up there. It's one of the greatest things ever. Another rude tweet was Jerry trades Tinker Toy hobby level systems. It's got to be there. What's going to take that down? So I Googled Tinker Toy. I'm pretty sure as a kid I had Tinker Toys. I Googled the correct spelling. I just hope Elon lengthens that possibility so I can keep adding, because I've had to take some things down.
And the funny thing is if we listen to any of the voices from all different walks of life in our lifetime or before us, I mean, people like the physicist Richard Feynman or Steve Jobs of Apple, all you have to do is listen for a few minutes and all these guys say the same thing. Simplicity, simplicity, not complication, simplicity, keep it simple.
Today's managed futures CTAs, they talk a big game. The next paragraph will be something about how it's not that simple. I think a lot of it is defending the incentive fee. Do you listen to Niels's podcast at all?
Sometimes. I think you're probably going to go to the most recent Brian Proctor one.
Yeah, Brian was pretty good. He did a whole series with the top CTAs that Andrew Beer replicates, that SocGen CTA index. It was really insightful. But I mean, Brian was a prime one. He would say, keep it simple, keep the variables low, and the parameters more or less constant. In the next 5 minutes, he would just go into this amazing complexity. So I don't know how they reconcile what they want to say versus their actual practice.
Let me get you to pull on this string for a second. So if someone sits down and they kind of write out a system, they write out a trend following system, it can be quite simple. I think the complexity becomes imagining what that simple system is able to do. There's a lot of complex philosophical thought put into a simple system. These simple systems are doing some very complex things. Is that a fair way to say it?
I think so. I haven't seen better performance than, I call it one entry, one exit stop loss. I haven't seen materially better performance. If they all had this amazing extra performance, I'd probably just keep my mouth shut. Why wouldn't I? I mean, why would I keep bringing it up? But I haven't seen much of that. Managed futures evolved into certainly not letting profits run and being very interested in sharp and smoothing things out. That's a shame. And then we learned from Rich, but I think with us, we didn't come in with any baggage. There was no quants, PhDs. There were some smart guys there with bachelor's degrees, but we didn't have anything to glob on top of trend following. And the Europeans had all sorts of stuff. And then trend following needed to, we'll just decide how much trend following we'll let in, but we're certainly not getting rid of all of our maths and all of the stuff we've learned that makes us physicists, PhDs, scientists, quants, and the institutional clients. They just eat that stuff up.
Those first 10 years of track records out of a lot of the European CTAs, they were doing the same thing as guys over in the States, I suspect. I think, tell me if you see it differently, but I would hazard a guess as the AUM went up and time went on and the amount of money the firms made went up, that might have been where some of the marketing complexity came from.
Definitely. I think that's fair. And then defending the incentive fee, I think that's the big deal. We may not really agree with these things. We may obviously understand as much as Jerry does. It doesn't really move the needle much on performance, but we got to have this aura, this storyline about why people should pay 20% of the profits. I moved it the other day. I had as my pinned tweet this statement from one of the bigger CTAs that I kind of actually like. I can't think of his name, but it's a big firm. And Niels had him on, and he basically said on there, if you regress CTAs, 90% of what they do, it's all about trend following. Everything else doesn't even matter. 90% of what they do explains their returns is all trend following. I had that up there for 6 months. It was so beautiful. I loved it. That's from a firm who has all kinds of capability for research and coming up with more sophisticated ways.
There has been innumerable ways that people have tried to run from trend following. I can remember the book, and he's a nice guy. He was on my podcast, but okay, we have the quote, time series momentum, trend following. Then we have the cross-sectional momentum, relative strength. And then I said, well, where are all these cross-sectional momentum track records? I mean, I'll trust you, Mr. Person out there, but where are the track records? That was always the thing that struck me. Even when I first heard about you back in the day, it was like, okay, I could open up the Stark report and I could see Chesapeake Capital month by month, and I could compare that. Here's EMC Capital over here, and here's Eckhart over here. Here's Dunn over here, and here's John Henry. I always thought that was so useful. You could see, okay, these were trend following traders, but some of these other strategies sometimes get buried in the mystical waving of the hand.
Academia, the wonderful papers that they write. Cross-sectional has major problems, and I don't even know if people trade it, but that's an academic's attempt at trend. And one of the iterations, one of the improvements on it was you're long the top 5%, then you're short the bottom 5% based on trend or the past 12 months. And then for many different reasons, they would say, well, you have these crashes where the shorts rally and the longs go down a lot. One of their improvements was to add, well, we're not going to go long things if they're in a downtrend or short things if they're in an uptrend. So let's overlay it with time series. Yeah, no shit. I tell you what, if you just do the time series, you'd probably be a lot happier. But yeah, it has a lot of problems as far as sample size, I think.
Of course, a lot of people know about your start, and they know how much inspiration you got from your start, how much confidence you got from your start, a very unique start. But here you are getting ready to start the 5th decade of doing this. What is the motivation? I mean, you don't have to do this. You've got a few extra pennies in the bank. You can kind of just chill and go to Super Bowls and stuff like that and hang out. You don't have to do all this. You've got a certain energy about trend following right now. I think even more so, and maybe it's just because you've gotten used to it and you like it and you enjoy it, but you're becoming a trend following personality for sure, 100%.
Well, obviously it's fun, and that's pretty much what motivates me. It's really fun. I have a great life. I have a great day every day. I find it almost impossible to do things that I don't enjoy. I had to write 2 forwards to 2 books, and I had months. These guys in Brazil wanted to translate a book, and they wanted to translate it into Portuguese. And they asked me to write the forward, and then another guy wrote a book following the trend, Clano. He asked me to write the forward, and I had months to prepare for this. And I just was paralyzed because I don't want to write it. I said yes, but I didn't want to write it. And so I find that that's the problem with me, is that I'll get up early to prepare for this, but then just something even minor, it's not going to be that much fun. I had to force myself to do it, and meet the deadline by 5 minutes. So it's just really sad.
You mean for the podcast or the writing?
The writing.
But podcast is easy now. You can just turn it on and go. That's just fun. Say for me, it's like you just get a chance to talk with people. We've all gotten more isolated as time goes on. So it's just fun to talk with people,
Yeah. Reminiscences of a stock operator. That's what I wrote, translated into Portuguese.
The most famous book on trend following that probably doesn't say trend following in the book, I'm guessing.
Yeah. And I know Rich was kind of down on that book, and he was down on the guy because he committed suicide and stuff. He's like, how good of a trader could he be if he didn't survive? And survival is the most important thing. You got to survive for 50 years and not blow up and keep it together. So he didn't really like that book or that guy. And I thought it was kind of interesting, but I've never read a book, maybe except yours, of course. Someone sent me something from your website yesterday of Donchin. And with all due respect for all these people, I've never read a book where they had it all correct. And I was like, no, you can't do that. They have it wrong. I would change my mind in a heartbeat and I would give them credit. I'm like, oh, yeah, Rich got that wrong. This guy kind of got it more right. Because I'm long, long gone from needing to defend Richard Dennis, for God's sakes. But no one had it together in a complete package like Rich and Bill.
I tell you, it still strikes me, being in Asia, that particular book of mine is the book that people gravitate to. And part of it has to do with the Asian cultural perspective on turtles. There's something that's completely unrelated to the nickname, with them not even knowing about it, whereas there's just something fascinating to the word turtle. And then secondarily, they find out about the story.
That turtle nickname is pretty cool. I think it worked out really well. Another thing that pisses me off and keeps me motivated.
Hold on. I like that line. Hold on. Another thing that pisses me off that keeps me motivated. I've got a list of these today, Mike. I got like 10 of them.
I have a list every day. It's not just today. But one of the things I found in my older age, but I don't think it's necessarily just old age, is I don't really enjoy sports any longer because I hate for my teams to lose. It's just like the markets. I hate to take a loss, and winning the championship. My teams have won some championships recently, and I have enjoyed that, but just them losing just sends me in a tizzy. So I find myself rooting against teams. I'm following these teams that I really dislike, hoping that they'll screw up. And that kind of motivates me. Like the Lakers, I can't stand LeBron or listening to him and his attitude. So I just like follow some of these guys and I'm rooting against them, not for them. So it's kind of sad. But I keep telling myself I need to focus on movies and TVs and get away from sports. It's just too nerve-wracking.
I relate to it in the sense that I started to grow away from sports too in the last 20 years. And I think it really started for me once the Redskins got a new owner. Pretty much after 20 years of that, I was finished with all sports.
I know, especially the NFL. That was such a shame because we were huge fans my whole life. My son is as well. But maybe they'll turn it around now.
Let me bring something up with you guys. It was a tweet I caught on your Twitter thread, and you're so easy to prepare for. I can just find out what you're interested in. I think you were quoting somebody, and I'm paraphrasing a little bit here, but it was something to the effect that trend followers' year can be made by anything. And they were quoting, it could be rough rice, oats, OJ, T-bonds, NASDAQ 100, crude. For a guy like you who likes to get down to the nitty gritty, I'm not trying to put words in your mouth, but maybe you don't think that's such an important thing. But I still think that this concept of my year can be made by anything is a fascinating concept. I think I could sit there for like hours and try to explain to somebody this idea. Even smart people, they just kind of glaze over. There's something about the idea that you are agnostic to where the profits come from. Like there's an emotional attachment. I must get my profits from XYZ. And then if you tell people, well, I don't care where the profits come from, it's kind of like they almost think I'm playing with them or I'm stupid or something.
That's right. And it could come from anywhere. We're bombarded all the time by stocks are superior. Stocks are the core. Stocks have the better trends. And I don't believe any of that. So there will be, every now and then a certain sector that has the best performance, and it could be for a long period of time. And stocks have had their day in the sun probably, and they're still great. I trade a lot of them. And so I'm always very happy. I'm never rooting against stocks or trends in any market, but it is true that if you're hunting outliers, as trend following kind of does, you can get that big, huge outlier from anything. And it can be in a related market and in a sector. And the interest rate moves last year, it was just a big sector move mostly. The short-term interest rates may have gone a lot further than some of their other ones. I think that's been a big change in CTAs as well, the managed futures CTAs. It is almost all about the sector move, not about orange juice or not about Tesla or some big, huge monster trade that where it can come from anywhere. It doesn't come from anywhere. It comes from the group, which is much different than classic trend following. And there's been times where heating oil doubled and crude sat there. You just let the profit go and they're highly correlated. They went back to being correlated. But for a short period there, you can get a big outlier from a market that you think, well, it's heavily correlated to a handful of other markets. So why trade them all? And take that in consideration. So trade it small. It's such a mistake. I remember Brian Proctor made a fortune on that silver trade when silver doubled in 87 and gold kind of sat there. But with managed futures, it's evolved into volatility management. We've got to tamp it down. If we get a big outlier, and its correlation goes up and volatility goes up, this is a problem. A problem? Wait a second. Yeah. So it's turned from, it used to be what we're hoping for and banking on, the 5% of the trades that are going to have this outlier performance, to no, they are problematic. And we need to tamp down the yen short, tamp down the British pound short, and make them look like the other currencies, because they're getting a little crazy here. And the vol that we measured at entry is much higher now. And this is causing extra risk. I used to really dislike this term managed futures, and I wanted to get rid of managed futures. Who the hell am I to get rid of anything? But now I love it because it's a very good label. This is what the vast majority of people do. It's not so much letting profits run anymore. It's Sharpie and volatility equals risk. And then just a handful of Chesapeake, Mulvaney, Moritz, Richard, four of us basically who let profits truly run without regard to volatility.
Let me keep it at the phrase that you just used, hunting outliers. I think that came from your trend following posse that you hang with. I don't think I've seen that term until the last handful of years or year. Was that your group responsible for putting that out there?
Definitely Richard Brennan. I think he gets that credit for that. He's obsessed with this, and he kind of helped me see at a deeper level, which makes it more fun to understand this simple topic and see how deep you can go and understand what's going on in the world and the markets. He sort of coined that phrase.
I had a reporter on recently, this guy, Scott Patterson, and he's written a new book called Chaos Kings. And he's talking about Mark Spitznagel's strategy in there, which described to me is very similar, hunting outliers, but I think it's executed in an entirely different way than trend following.
Yeah, I don't know too much about it. I read everything that I can get my hands on about him and what he says. It's a little bit about outliers for sure, but he doesn't love trend followers. I'm not really sure what they're doing. I read a lot of pros and cons about that particular strategy.
Yeah, some of it came up on the episode. When you use the phrase hunting outliers, okay, let's assume there's some people listening and they instantly get what hunting outliers means. Put your Bill Eckhart teaching cap on to 1983. Let's say he was using the term hunting outliers. Start to explain that to the average person that maybe has not heard that term.
Yeah, it's pretty simple. I mean, you want to trade all these markets, long and short, lots of diversification, currencies, commodities, stocks, and bonds. And then when you do a back test with straightforward trend following strategy, you'll see that if you let the profits run and don't get out of them before the trend turns, about 5% of your trades will be responsible for all of the profit, and everything else is kind of a small plus or minus. And that's historically been trend following. You're preserving your capital, taking these small losses. You're sort of separating, from the very beginning, the cliche says, take small losses, let profits run. It's making this distinction between, is it a profit? Okay, then I know what to do. Let it run. Is it a loss? Okay, I know what to do. Don't let it get to be too big. And then sometimes profits turn into losses, and the losses turn into profits. You're supposed to let that profit run. The computer tells you, oh yeah, if you let that thing run and don't scale it back based upon a profit objective or a correlation increase or a volatility increase, you'll make more money, but you will have some more open trade volatility. So we feel like that's a pretty good trade-off, and using something like Sharp or volatility as a measurement of risk is not really accurate. But clients don't really like it. They don't like these outliers. They cause problems. And so let's just scale it back and let's stick with the trend, but maybe we have half the position or a quarter of the position now because the volatility has gotten so high. They sell this as there's no downside to this. There's no opportunity cost. It's a freebie. Risk cannot be eliminated. It can only be transferred. Well, not in this situation. They've convinced themselves and their clients that you don't have to eat your broccoli.
Something that you were chatting on your Twitter, this idea that maybe they wrap their arms around trend following, let your profits run. And then they have to have that wake up moment where it's like, hold on, I let my profits run, but I could lose all of the profits on that particular trade in that particular market. Like I could run it all the way up and it could run all the way back down. I might have to give everything back. And I think the smart people out there say, well, hold on, there's a way that I can fix that. Why don't you give your best explanation as to why fixing that changes the trend following golden goose, which is sometimes you got to live with that.
I think one of the things that a systematic approach like trend following offers is if you run a reasonably robust back test. I like the one entry, one exit, one stop loss idea. And then you have multiple of those different entries, exits, and stop losses. It promises you that you'll make money over time. 40-year career or whatever, you'll do fine. This is what we take away from that is we got a lot of trades to look at over our career, over a long period of time. We're going to do the best. But what it doesn't say anything is about this particular trade today. I mean, what's more important than this trade right now? I can tell you, nothing. There's nothing more important. This month, this year, relative performance, I got to beat so-and-so. I can't bear. Now, they want to blame it on the client. Oh, well, clients can't put up with that. Traders who cut profit short, come on. Don't blame it all on your poor client. You love it. You would do it if you didn't have any clients. I think you just make less money. And obviously, the downside, where did that risk go that you've taken it off the open trade equity where you could most kind of afford it? You put it into bigger losses. If you're going to have smaller profits and you're not going to let them run in order to make the same amount of money as someone who does, you just got to trade a bit bigger. And so rather than losing 25 basis points per trade, maybe you lose 30. Obviously, that's where it is. You have a systematic approach that has 40% winning trades. That doesn't sound too good, honestly. I don't like it. Now you've increased the size of the loss. But systematic trading is built upon this whole idea of as you add more markets and as you get better systems and your risk goes down, you can trade larger. So you trade a bit larger because your Sharpe ratio is better, even though I've already said I don't think that's a very good measurement. So you're building this house of cards where your sample size has been impacted. You're taking larger losses. You're shifting that risk from open trade equity to your capital. That doesn't sound too good. So that's where that risk goes. And the clients can't see it. Mulvaney's open trade equity fluctuate and have these huge swings, even though he's still up 20, 30, 40, 50% for the year. But underneath the hood, you don't see this incremental large. Every time we take a loss, it's a little bit larger. We're paying for that smoothness by having to trade larger and leverage up a shakier system. Doesn't sound like a good trade-off to me.
Let me push back on something that you just said. 40% losses as a trend following trader. You said you don't like it. Why don't you clarify that a little bit? Because your entire life has been off these kinds of losses. Actually, 60%, I think was what you meant to say.
40% winners, 60% losers. Sorry.
Your whole trading career, this fantastic life has been based off 60% losers. So when you say you don't like it, I don't know, do you really mean that?
I think it's okay to admit things you don't like, small little characteristics that you wish were different. But I certainly love that particular strategy that has 60% losers and 5% of the trades make all the money. I love the overall systematic approach and my systems and my drawdowns and everything about it. But yeah, we can all admit that, boy, wouldn't it be nicer if it was higher? Human beings love to take a profit and to get that pat on the back from yourself, even when just a one tick profit. One of the funniest things was Rich would always say he got into the business and he just spent a lot of years proving these cliches wrong. You can't go broke taking a profit. You've heard of this thing where you move your stop up to break even. At some point, you have a profit, so just move the stop up to break even. And of course, the computer will laugh at you and say, oh my gosh, that's really a bad thing to do. But that's just a common sense human thing. And common sense human things don't usually work very well in trading.
I don't know if I told you this before, but you should grab one too. I'm sure you could find it on eBay. But I picked up one of the original copies. I think it was from the New York Times Magazine, the first review of him back in the day, like 1976, I think it was. Just fascinating to see that. And I mean, his attitude, it was just so like, hey, here I am. Take me as I am. This is what I do. I'm not trying to impress you. I don't know. Maybe some people don't like that. I'm one of the types of people, if I see that kind of attitude from somebody, I love that kind of attitude.
These guys had great personalities, they're great humans, but they are super smart, man. I'm telling you. Because when they walk into a room, it doesn't take much conversation to realize you're in the room with some special people. I was like overwhelmed by just how smart they are. I'd never seen anything like this before. That's why it rubs me the wrong way, because a lot of times I'll read an article and they'll say, we started our firm and we brought in math and science and computers to take over for the people who were in the pit, codified their pit rules, and taught it to a bunch of turtles. It couldn't be further from the truth. We were on day one dealing with the smartest people as it related to trend following and systematic trading and computers and programming. And they fully equipped us to survive for the rest of our life. And I think some people have been able to do that. I would tell you if I would say like, oh yeah, I went to this seminar, I heard this person, they were really reminding me of Rich and Bill. Yeah, I'm still waiting on that.
I don't know if you knew him, but I think Bill Dunn was right there in the same headspace.
Yeah, I had one cab ride with him and I really like him, but I don't know any of the details of how he actually trades.
Give me a contrast. Here you are 40 years into this. Now, of course, you're going to know a lot more about the machinery today, about every detail than you would have known at, let's say, age 25 or something. But how has your psychology evolved from, let's say, the first 4 years of being a turtle to the last 5 years? Has there been an evolution, or have you just found a way to keep yourself consistent? How has that moved over the decades?
I was always a person who wanted to get deep, deep, deep into the philosophy. So as the specifics would change over time and the things change, markets change, the world changes, I'd still be able to have this bedrock set of principles. And we were just given bedrock set of principles. They were not going to really change other than.
But what about you? Did you change at all? Or did you have this early philosophical understanding and you've just built other systems to keep your system in place, so to speak, your personal system?
I don't read the Bible, but I hear people say, I've been reading the Bible, the same chapters or verses my whole life, and it's now I understand them so much better. And I think it's the same with me. I mean, I just think about this stuff. It ruminates in my head. I live life and it gets deeper and deeper and I understand it better and better. And I just keep going back to the original transcripts, what we learned and what they taught us. And I feel like I have almost a photographic memory of what they were telling us and what was important and what they said and interactions. So I strayed away and got punished and had to come back to what they had taught. I think I've made a couple of minor improvements. We certainly trade longer term than we did back then. When I left there, I was taught systematic trend following and how to keep it going for the rest of your life. And I thought this was the greatest thing ever. But I think over the past 5 or 10 years, I realized that they didn't really care about trend following maybe as much as I did. They were more focused on systematic trading. And they have no intention of trading anything similar to what they taught us now. Whereas I left there thinking we're all kumbaya trend followers. I was wrong. We were all systematic traders. And as you interview other turtles or you talk to them, they are doing things way different, let's say, than what they taught us. So I was really the one who misinterpreted that because I wanted to. I fell in love with trend following before I met them. And that love has only grown deeper every day of my life. And how wonderful it is in every way. That's one of the things that motivates me with this new ETF we're coming out with. It's going to be 50% single stock. So I am not a managed futures person. I put trend following above everything, and I want to make it as good as it possibly can be before I depart. And that's my sole goal, is elevate trend following into what it could become and should become, not managed futures.
Tell me about your ETF.
Like I said, it's going to be the perfect portfolio, not the perfect hedge. One of our friends sent me an email 5 or 10 years ago, and the title of it was some marketing email, like the perfect hedge. I called him up and I'm like, you don't agree with this, do you? He goes, no. Yeah, it's not the perfect hedge. It's the perfect portfolio. So in order to have a perfect portfolio, we've got to have a lot of commodities, currencies, and interest rates, long and short, trend following. and a lot of single stocks. There's so many to choose from. It deserves quite a material part of the portfolio. And rather than allocating 5 or 10% of your portfolio to CTAs and trend following to help out with crisis alpha, let's trade our stocks with trend following so we'll maybe have fewer crises to begin with. Obviously, this is something that should have been offered to clients years and years ago, because the CTAs themselves are not going to advocate for taking arguably the most important part of the portfolio and wrapping trend following around it, this wonderful strategy that preserves your capital and makes a really decent return. Who is? And I think that's what essentially has happened, is that managed futures knows its place. It has its little place. No one wants to upset the apple cart. Trade those indices. Give me the 5 or 10%. It's like the Stockholm syndrome. We're kind of siding with our captors.
As you keep using managed futures essentially as a pejorative, I assume from the Jerry perspective, there is managed futures over here, and then there is a handful of people that we can discern are pure religious zealot trend following traders over here.
That's right. But also remember, the only reason we believe that is because of the back test and the numbers that prove we are correct, that the best way to manage money is to let those profits run. I mean, there's other components to what we do, but that's the fault line. To what degree do you let profits run and have some volatility and give back some profits? And that's what's been missed. That's where managed futures took a wrong turn. The other day, I tweeted something, or I was talking to people about listening to Buffett and Munger and all these investments they have and all of the wealth they've created. And I said, do you think they've all managed? They got this stock that they're making a fortune on. And one of them walks in and says, hey, the volatility is really high. Let's get out of this thing. It's the silliest thing on the planet. Plus, the numbers don't back it up.
Everyone shows up to Omaha to salute these 200-year-old stock pickers who have a very narrow portfolio. And I think their portfolio is half Apple now. And essentially, it's just big concentrated bets looking for big home run trades. But it's apparently not legal in the trend following world to have such a thing.
Yeah, too much volatility is a problem. Clients don't like it. You can't raise money that way. But we'll see what happens. We're going to come out with this pure trend following strategy that trades 300 markets, and it's going to have a fair amount of stocks in there to get the potential outliers and to participate. We don't want to go through another 10-year period of a lost decade for trend following, primarily probably because CTAs weren't long the best trending sector, which was the stocks. And these indices, you don't get much of a chance to get a big outlier. So we're not going to let that happen again. And we'll see a fair representation of what trend following can do when we give it all the advantages of those single stocks, long and short. We have lots of shorts on now, lots of longs, just like we do in the other sectors.
They're just additional streams of numbers to trade.
So much fun researching and finding unique companies that do lithium, uranium, steel, eggs, French fries. So much fun.
But those are the names. You don't necessarily care what the names are. I mean, you could trade them without knowing the names.
But I do think that I want to have lots of diversification, give myself a decent chance. I mean, it's not like I don't want diversification. It's not like I embrace volatility and I just say the hell with it. No, I want to have a lot of longs and shorts and a lot of diversification in those sectors. And I want to try to smooth it out, but in a robust way that I'm not compromising with changing my rules and adding things to trend following that may introduce some negative skew. It's all positive. It's all putting your fate totally in letting profits run and taking small losses.
Let me ask you one last question, Jerry, before I let you escape, unless you don't want to escape, unless you want to just keep picking you for questions here. I was thinking this is something also from your Twitter, and I'm just kind of paraphrasing a little, but it was something to the effect of talking about when markets move, the source of trend following profits, people ultimately buying and selling markets, and the fact that humans have not evolved very much. I would love for you to kind of clarify a little bit there, but then I started thinking about that. It's like, not only have humans not evolved very much, but there's not enough time in life right now to get there, so to speak. So it seems like maybe by the time generations get to a certain point where they might be open to or finally understanding trend following after going through 20, 30, 40 years of Wall Street just feeding them whatever storyline they're fed, but then life is over. I think that's one of the disadvantages, in that there's not enough time maybe to get to the trend following understanding when you have to go through the Wall Street minefield selling you everything under the sun.
Yeah, that's a good point. I feel like, though, read about trend following when I was in my early 20s. I understood it. I loved it. I embraced it. Longs and shorts, of course, that's got to be better. Small losses. Look, the profit's going to pay for the small losses. I love it. I love the objectivity. Adding more markets, currencies, commodities. Sure, why not? I've never been a fan of, we got to educate people better. People can't understand it. I understood it. Anybody can understand it. I think what motivates people is politics and money. So it's not politically acceptable to allocate all your assets to trend following. I'm smiling. Of course it's not. I mean, it is for me, but it's not for anyone else.
So you were an outlier who trades outliers.
Yeah. People are greedy. And when I got into the business, we were making money and people were throwing money at us. And I think when we try to refine this strategy and make it as all it can be and give it all the advantages, primarily trading these stocks and as many other markets as possible, I think people will see this performance and they'll just be greedy. And you'll call them up. They'll call you up and say, I'm going to give you a lot of money. And you'll say, well, last week you said you didn't want to give me any money. Well, look how well you're doing. So miraculously, born again believers, because it's doing too well.
I got to ask you, since you just brought something up and it just struck me that, okay, back in the day when the Turtle program ended, for whatever reason, I'm sure there's a lot of reasons, your particular company, Chesapeake Capital, really took off in terms of performance and AUM. And it was very mysterious at the time because it was still, a lot of people really didn't have a handle. I mean, behind the scenes, people knew, but the general public didn't have a handle on what the quote turtles were doing. That must have just been so crazy exciting.
So exciting. It was so much fun. We probably made money the first 10 years. And that's what these sort of systems will do. One entry, one exit, and a stop loss. They're very consistent. So their hit rate per year of the trailing 12-month return, positive return, is so high. And that's sort of what they're able to do. You're letting these profits run. They're sloshing around. It's so much volatility. And yet they're very consistent. People find that hard to understand. We do these back tests all the time. And it's just like, it's really hard for this type of strategy to have a losing year. Now, some of the years may be 0.5% or whatever, but they're very consistent. Chesapeake makes money almost every year. And people love that. I remember walking around Manhattan and going up to a payphone trying to get a meeting with the guy who ran Merrill Lynch Managed Futures. I called, someone picked the phone up. I said, oh, this is Jerry Parker. Can I speak to so-and-so? I'm at Chesapeake Capital. And she says, hold on. And she goes, no, he cannot talk to you. And then I said, oh, tell him I'm a turtle. And then she comes back and she's laughing. And she goes, yeah, come on up. Having that track record, that 4-year track record, was so important. I mean, you've got something to show people.
To add something, though, too, not only do you have the 4-year track record, so that's one period of your life, but then, and correct me if my numbers or my dates are wrong, but I think once you got into Chesapeake Capital for 3, 4, 5 years, then 1993 was like the year of you just going to the moon, right? Was it 93, I think?
Yeah, that was a really good year, plus 60%. Everything was working. Everything was great. We had it together. But I was not immune to trying to make it even better. So let's try to make it even better. Let's get rid of these drawdowns. And I think that's sort of what I was saying earlier. I have gone off the straight and narrow path because you're making money. You want to improve. How are we going to improve? Well, let's get rid of volatility. Let's get rid of losing periods. And so that's where you get in trouble and you start killing the golden goose, which then you have to revert back. And I remember one year we really over-optimized our systems, and the first 3 months of the year looked so different from the 25-year back test. We were just like, oh my God, we've never even seen 3 months like this with these stupid systems. So we're like, this is dumb. We got to go back to our roots and trade the way that we used to trade where we had all kinds of blemishes and faults, but we made money almost every year. We know what success for us looks like. And so I turned the page back. And I remember that same year, there was another CTA who had really suboptimal performance. And they started this monthly newsletter, almost saying the exact same things that I said. But their conclusion was, we're going to double down on the research and come up with even more complex, better systems. We're not going to revert back to what's got us where we are. And I was just like, okay, this is just who I am and my personality. I was given this incredible gift of knowledge and trading, and I got away from it. And it's okay. I'll be perfectly fine in my career just having to give 99% of the credit to Richard Dennis and Bill Eckhart. I just want to be successful. But we all stray. It's just, how soon are you to get back to what you know used to be a safer path?
I think it's one of the nice things you just do right there is you always express loyalty. You're always humble. And then you're being very honest about the ups and downs and mistakes. And so, heck, even if people weren't interested in trading, I would implore people to take a lesson from that idea that if you do get a chance where someone shares something with you, and a lot of people have shared a lot of things with me, and I try to make those people look good too, because they've shared a hell of a lot of information with me. But being loyal to those people that you might meet early in life is terribly important, regardless of what one does in their career. If someone's good to you, I mean, I think karma's real. If they're good to you, it comes around.
Right. They were so good. And it's easy for me to be the one person that is going to try to carry it forward with as close to what we were taught as possible. Yeah, one person should just try it. And it's easy for me because I really believe it. It was a great experience. One of the things I've said before is that you can hand someone a manual and say, go be a Marine. But look, man, if you get that manual, plus you get 4 or 5 years in boot camp and men and women training you how to do the job, it's so much better. We would have been so much better off if we would have had 8 years or 12 years with those guys, just formulating and starting your career. And the bottom line being told, do the right thing, follow these rules. If you lose money, it's okay. And when we did lose money, they gave us more money to manage and just said, hey, you're doing the right thing. Don't get down. Just follow your rules. That's just not a real world experience. When you're out in the real world, clients are like, look, if you have to break your rules to make me money, you just go ahead and break them. I don't care. And get out of that trade. Don't get back all that profit. So just having those years with them combined with the superior knowledge and training we got, where would we be with another 4 years or a total of 12 years? How much better we would have all been.
Remember, Jerry, though, as you describe it, this was a terribly unique situation. There was not too many of you. This was not something that was done a lot in the 20th century. It was a pretty unique thing. Hey, listen, you brought up the new ETF, but where can people go? What should they know about it?
Well, thank you. The ETF symbol is TFPN, Trend Following Plus Nothing. The name is something like Blueprint Chesapeake Trend Following Strategy. It won't be hard to find. Won't be hard to find Chesapeake Capital, Blueprint Asset Management. Yeah, I think it's going to be quite a fun project and looking forward to being in that business.
One last thought here. You said to me before we started, hey, are we going to do anything with this video? I think we both look pretty good in this video. I think we should use some of these clips. We can find a couple clips in here. Yeah.
I love these videos.
I thought maybe you were going to show up, I don't know, hair sticking straight up or something. You look fine.
Well, it would be sticking straight up if it was longer. But yeah, it doesn't look too bad. But yeah, no, I agree. I think putting this out on YouTube would be really good.
We got some nuggets.
I need people to see that when I'm saying some of this stuff, I'm actually laughing. So when I get all uptight about what I believe in, I'm really not too serious about it all. But yeah, thanks for having me, Michael.
Yeah, cool stuff. Hey, anytime. In fact, I was thinking to myself, gosh, we did episode 1000. It's like, where's time fly? But hey, anytime, sir. Thank you.
Thank you.
Wow, 1,000 episodes. I did not expect in 2012 And I can kind of remember starting this podcast in 2012, but I could never have imagined that I would get to 1,000 episodes. I'm one of the few people in the world where you can probably take my words, dump them into some kind of AI, and create an artificial intelligence Michael Covel right now. Take all my books, take this audio content, throw it into a blender, give me a new subject, and the AI Mike can probably keep going on forever. That's kind of fun. I think that's my goal now. But 1,000 episodes is a cool number. It gives me something to shoot for. 2,000 episodes. Now you might be thinking, who could I pick for episode 1,000? I can pick a lot of people. A lot of really smart, influential people in my life. But I started to think, what was the first trigger? The first trigger of my career. And that trigger was going to a Salomon Brothers interview in 1994. It didn't work out. Walking into a Borders bookshop, seeing Financial World's top 100 paid on Wall Street, and seeing a blurb in there about my guest today, Jerry Parker. And that just triggered me. That article, and I'm not going to quote it today, but that brief little paragraph said something like, Jerry was in Southern Virginia, he was using a trend tracking system, and he was trained. And that was the magic moment for me. I thought, well, I don't know this guy, Jerry Parker, but if he could get trained, why the hell can't I get trained? I just finished my MBA. I thought I had to know balance sheets and Warren Buffett and all that kind of stuff. But here in this one little magazine, one little article, this guy who lived 90 minutes from me, what did I do? I got in the car and I drove to his office. Guess what? He did not agree to meet with me. He did not agree to meet with me for 18 months. And finally, I sent him a fax. And the fax said something to the effect of the top 10 reasons you must meet with Mike Covel right now. A few minutes later, his assistant called me and said, you got 30 minutes on this date. I went down there, 1995, December, I believe, the first moment I met my guest today. That's really cool. That's fun because now he gives me the time of day today. I mean, I've tried to do a good job on my prior interviews with Jerry, but I'm very excited, as always, to bring on the most successful turtle trader. And if you don't know what a turtle trader is, you've got some kind of mental defect. Go figure it out. In all seriousness, my guest today is one of the legendary trend-following traders of the last 30, 40 years. What a great story. Today, I will take Jerry around all kinds of subject areas. There's no telling where we will go exactly. That's always the fun of a podcast. Just go off and see where you end up. Without any further delay, let's jump right into my 1,000th podcast episode with Jerry Parker of Chesapeake Capital, one of the original Turtles, and definitely the most successful of the original Turtles. I hope you enjoy. In 1983, could you imagine having a conversation with 2021 Jerry and 1983 Jerry? What would that conversation be like?
It would pretty much be you're setting your sights too low. You never really know what's going to happen, especially if good things start to happen, incredibly good things. You could always just be so satisfied with what you know, what you expect. Life is always usually good, especially for spoiled Americans. Life is good wherever we are, whenever we are, we're happy. We got big plans, big expectations. But in my lifetime, your lifetime, one of the hallmarks has been it's really easy to exceed your expectations because of the way the world has evolved.
Well, let me keep you at that 2021 to 1983, Jerry, and even get more specific. You've now become Mr. Prolific on audio and video. When I first started chatting with you, probably in 2013 or so online, you had not been doing a lot of this at all, but now you're freaking doing as much as I am now, or maybe more. I don't know. But tell me about, though, more specifically, that 83 to 2021, I'm kind of noodling around the trend following world there because I guess in 82, 83, you had some inkling about trend following, but that was a pretty big turn, a pretty big change in early 84 for you. And you contrast it today. Do you ever think back to like, what a wild ride?
Yeah. From day one, I understood very clearly the opportunity that I had and we all had and how amazing it was, because that's the biggest takeaway from the Turtles is just we were taught by these genius traders who could have probably done very well and made a lot of money in a lot of different fields. We started at the very top from the best. We had a pretty good expectation of what we were learning and where this could take us. And then all of a sudden you start making 100% a year, 200% a year. But leaving there and starting your own business and the managed futures industry would expand and CTAs would start getting lots of assets under management. Yeah, that was all sort of brand new about how it was all going to happen, honestly.
Let me keep it at a thought about you, though. I know you are very humble about these kinds of questions. So, okay, look, it's a great story. I've written a book about it, The Turtle Experiment, The Turtle Story, and a lot of people did well for a long time. But I think you're going to win the endurance contest when it comes to the turtles.
Well, part of winning it is wanting to be in the game, even after you've made enough money. And then the second part is sticking with the principles. And I think that that's where I definitely deserve first prize in that, because I did stick with the trend following principles. As I told you, one of the lessons I learned recently was that I think that my mentors were more interested and wedded to systematic trading rather than a trend following. It didn't have to be trend following for them, I don't think. All I did is I got experience in the late 90s was just continue to trade longer term and extend my look back period and stick with the same strategy. Hardly no changes. I mean, I would do research and come up with changes that I would later say, oh, that wasn't a good change. I need to revert back and not add bells and whistles and unnecessary things to try to prevent drawdowns. I mean, that's where it all sort of comes in. You want to get rid of those drawdowns, but just sticking with those principles and just looking at the world in terms of trend following. Everything is just through the lens of trend following. I would even ask some of the turtles, like, I'm going to start trading single stocks versus indices. Some of their responses would be, oh, that's great, because then you can add in some fundamentals or some other ways of looking at stocks and choosing stocks rather than trend following. And my response was, no way, I would never do that. So I just absolutely always refuse to give up on those bedrock principles that I learned in December of 1983.
What strikes me about you and maybe some of the distance between, look, it's a little unfair. It's like, okay, a small group of people, as you say, get taught by these genius traders. It's a great legendary story, but maybe some folks get unfairly positioned into slots. All that said, I've had a chance to know some of your peers and meet some, and I've often found that there were many, and some are no longer with us, that were highly emotional. And I find what's interesting when you talk about trend following is you're kind of talking like a Zen master almost. You're very Zen about it. And I think maybe even though people, and you can correct me if I'm wrong, even though people can execute under the tutelage of Rich and Bill, then maybe when they're out on their own, they didn't really grasp completely. And I think you just said that a second ago. They didn't truly grasp what you just described, the emotional part, the living with it part.
Well, I think that you can definitely dig deep into this topic. It can be explained very simply. And I have children who want to trade and they're all in their 20s and 30s, but let's say they want to trade and maybe they're not the most skilled in math or they're just preoccupied with other things that I can teach them, buy here, buy this breakout, sell that breakout. And I think that to some degree, if they don't dig any deeper and understand even the math of it at all, they could probably make a nice living. You don't have to really get into it very much. And in some ways, if you don't dig too deep and you're kind of preoccupied with skiing or snowboarding or other things, I'll do my trades in the morning and then I'll go out and have my fun, then you maybe not be tempted as much to try to change it. For me, there is a lot of depth to it. And it was just like I was uncovering what it really meant and what the principles meant, especially as you apply them and you get faced with opportunities to not apply them. I've found that a lifetime spent refining your trend following is a perfectly great use of your time. other CTAs who sort of said, okay, I got the trend following nailed. I'll add mean reversion, or I'll add pattern recognition, carry trade, and all these other things to it as if, well, the trend is done. I know how to calculate a moving average, so I'm done with that. I felt like, no, that's not exactly true. You can dive deep into this and at least learn a lot about what works and what doesn't work.
The last year and a half, a really stellar trend following period. I know we kind of exchanged some emails. I had Don on from Purple Valley down there in Florida. For a long stretch there, we had a lot of people saying, you've seen this more than I, the trend following is dead meme. And all of a sudden, even you had some great trend following traders that we both respect who were saying there was a problem with trend following. And then all of a sudden, a guy like Jerry Parker, who sticks to his knitting, but I know you're not running around trying to say to people, I told you so, I told you so, maybe a little bit. But, you did tell people so.
Well, one of the big lessons since last fall, since it's been such a great move in so many of these markets, currencies, commodities, grains and metals, base metals, Bitcoin, lumber, some of these really stand out. Tesla, I was lucky enough to have Tesla in my portfolio. I think the big lesson, though, is it wasn't our fault. I think it could have been our fault to choose trend following. You cannot rely upon a method that has 5% of the trades are going to make all of your profit. And you've got all this diversification. You need to figure out when the commodities are not going to work and it's just load up in stocks and bonds. So that could have been a mistake to choose trend following and to choose diversification. I don't believe that. I believe in looking at all the data, not just recent data, and following the rules and not trying to figure out which regime we're in and burden your system and pollute your performance and your results with extraneous matters. The big lesson we learned is it wasn't our fault because we didn't have big outlier trades. And so we weren't doing anything wrong. Once again, apart from we shouldn't have chose trend following to begin with, possibly. Now we're all sort of humbled by what really pays the bills is these amazing trends that our main job during these trends is not to do anything. We bought the breakouts in October, November. The markets started skyrocketing. And as long as you didn't apply some sort of vol target or profit objective and just waited for your retracement and your trailing stop to be hit, which a lot of them haven't been hit yet, then you're going to do very well. And I think that's sort of the lesson is sell your soul, sell out for the outlier, whatever it takes. That Tesla trade, it went up a lot initially, 50 ATRs. It retraced 49, and now it went up 400. Depending upon your look back period, you could have definitely gotten out a few times if you're looking at the 50-day low or the 75-day low or whatever, which is fine. But if you have some longer term stuff, that painful drawdown is just the price you pay for hundreds and hundreds more ATR profits. It just takes guts to do that and not to pick up the phone or pick up your laptop and dial in and take some profits.
Let me keep you at a point that I did not follow up on when you were addressing that your two mentors early on, Rich Dennis and Bill Eckhart, that you would classify them as systematic traders, not necessarily trend following traders. But if I was to pick a little bit there, I would classify you as a systematic trend following trader, would I not?
Oh, definitely.
Why don't I let you explain what you meant by them being systematic and not necessarily trend following?
At some point in time, like let's say the late 90s, the trend following, the shorter term stuff that we use as the turtles, that didn't work very well and hasn't worked well since. So my simple idea was, well, let's just see how, if the 20-day low doesn't work, how does the 120-day low work? And just keep expanding your look back period so you won't get chopped up and whipsawed out of these large trends, with the cost being that when you do have the big trends, your trailing stop is going to be far away and you're going to have a bigger drawdown. That's pretty easy. And I think unacceptable for people who say, hey, that doesn't feel like a good return risk trade-off there. I'd rather look at something with a shorter time span, keep that 2 or 3 week look back. Your typical outlier might be 20 ATRs versus my typical outlier might be over 100 ATRs. And so I think that's probably what they were more committed to is, well, it may not look like trend following that we taught the turtles, but it will be systematic, rules-based, back-tested, and things like that. I think from day one of the turtles, it was pretty well known that Rich and Bill were skeptical about the future of trend following and the parameters and the way that they were teaching us. It was like, this may not keep working very long. And so I was like, what am I doing here? And so, like, before the turtle class was over, it was like a pessimism about how long this was going to last and work. So I think having that in your mind, that you need to always be worried about that, sort of trying to evolve away from parameter sets that are too enticing for other people, is a good mentality to have. And I've just settled it all by being so long-term and so willing to take ridiculously large drawdowns on profitable trades that I guess my assumption is it's not going to attract very many other smart people.
The principal part of what you just described, even if the parameter sets change, and you've already said this, going for the 5% outliers and whatnot, but the principles, why do the principles stay? Why, for example, a long time ago, two really smart, legendary traders were pessimistic. And okay, maybe by somewhat luck, I don't know, but okay, one of their students said, well, this long-term stuff, I think there's something here. And now we roll forward multiple decades ahead. A lot of people that were around back in the day, older traders than you, they're no longer with us. So I guess the real question is something like trend following as you describe it, that 5% of outliers. And with generations, at least until we get life extension, generations always coming and going, it sure seems like if somebody can live the Jerry Parker portfolio and live the Jerry Parker strategy, they might be okay.
Oh, definitely. I think one of the things that happened over the years was trend following started to change from what I would call the classic trend following, one entry rule, one breakout entry, a breakout exit, and a stop loss. As far as the signals go, can't hardly beat that too much. Maybe you can throw in one other thing on the entry side. It started to change from let your profits run to what's the sharp. And we need to be very concerned with these return, our performance, daily performance, weekly performance, monthly performance rates of returns. And I think that it's hard to let your profits run if you're going to be concerned about your volatility of your returns. We've got the risk covered. We're taking these small losses. That seemingly is great. That's our money management. We diversify like crazy. We do longs and shorts, and then we take small losses. But then it was almost like what really changed was we need to pay attention to our volatility of our profitable trades. And if it's a drawdown on a profitable trade, they've been redefined as losses. What? How does this happen? So just me rejecting that idea, there's no way to accept that and keep my philosophical head straight that you got to let your profits run. And profitable trades, you can lose hundreds and hundreds of basis points. Losing trades, 50 basis points, 25 basis points max. So this was, I think, the big change, and one that impacted and affected everyone, almost to a person, except a very small group of people like myself who refused to give in to this sharp and vol targeting.
I'm not sure if you're hinting at or saying it, but we had kind of talked a little bit in advance, and you mentioned the European trend following traders or European CTAs, and I'll let you define what you mean by that so people don't think it's necessarily pejorative. You talk about European CTAs having trend following plus other stuff. The other stuff, like trend following's not good enough. You got to add the other stuff. I think that's really what you're getting at, is that a lot of big name traders, people that I respect, people that you respect, did add a lot of stuff. And some of that's not worked out exactly right.
There's at least two kinds of stuff. One is the ideas that I've mentioned before: pattern recognition, carry trade, short-term, mean reversion, now maybe AI and machine learning and things like that to improve your trend following portfolio. Managed futures is maybe one of the few hedge fund categories, if it is a hedge fund category, that it's not good enough to allow allocators to allocate to pure trend. You need to create sort of a portfolio of strategies yourself in order to get assets. So that I never was really interested in. But I think that's the least offensive of the other stuff, which the stuff that's more offensive is the vol targeting and the paying attention to sharp. And trend following is the one idea that Sharp has no place. Upside risk, downside, I don't know what you call it. It's ridiculous. You're letting those profits run, they're profits, and your risk is these losing trades and how much you're risking per trade. And this is what I didn't like. And then these guys from the European CTAs that really hit it big, they were really great at building these great businesses. Hats off to the business aspect and getting the AUM. I think they kind of figured out that, well, if you want to have these big businesses and make a lot of money managing other people's money, you're going to have to take as much of the trend stuff as people can handle and maybe add in, well, we have these PhDs, we're going to manage the volatility more. We are going to pay attention to Sharp. No one asked them to do that. No client was saying do that. It's sort of a marketing thing or business thing where you can say, hey, you can stick around with these traditional trend followers with this big volatility, or we'll manage all of this for you into something that's a little bit more palatable and more scientific with all of our PhDs in different commitment to this traditional way of looking at markets, which is Sharp and volatility of returns. And it wouldn't have bothered me so much, of course. It's a great business opportunity to say, hey, I'll allocate to those guys and I'll allocate to people who do it a different way. And when I would go in and talk to clients or potential clients, I would actually say that. We're one of the few CTAs that doesn't vol target, and we just let the profits run, and we trade single stocks and things like that. So you need to have both in your portfolio. But I guess some of them just could not resist trashing the turtles and sort of trying to build up a legacy of, well, when we got on the scene, we made things a little bit more scientific, and they would call themselves scientists as well, which I guess is okay. I would be a little embarrassed, even if I deserve to be one, to call my trading science. But I think that that's what got me going, was the trashing of the turtles and sort of a simple way of doing things. And now watch us, we're taking it to a new level where in the long run, I knew it was not going to succeed better than a classic approach.
I think what you're really getting at is got to be something really tough for investors. I don't know if I should say allocators, maybe allocators to some degree, but for investors is to really dig through the weeds to find those base principles and to understand the base principles, and then to understand when someone or some group is doing what you are describing, the marketing, to be able to decipher that. I mean, you've got a hell of a lot of experience to decipher it. I've got a little bit of experience to decipher it. But I think for the average person, the glossy write-ups and all that kind of stuff, it sways people. And it is a very, at its root, I think, to understand what a Jerry Parker does, you've got to really get the philosophy first. To me, it seems it starts with the philosophy. What are the principles? Then you can get to the rules. Then you can get to the execution. But someone's got to truly understand what you said at the beginning of this podcast is about the 5% outlier trades. And that's tough, I think, for a lot of people to understand when there's so many other people out there yelling and screaming about they've got the next new thing.
Their performance was great. I think there can be periods of time where, sort of, in my opinion, doing the wrong thing and having suboptimal strategy can do very well. And especially if you have short-lived trends. There's been many trades over the years where I remember cotton would rally and it would make 15 or 20 ATRs and I would lose it all back. It would just crash the next week. And if you have what I would consider not a great strategy, but to take some of those profits, you can have what looks like a better strategy. Just clients are weak and they want to buy into it. If you tell them and you can convince them that you can have what you want and I can minimize the negativity, they're all over it. No one wants to hear like eat more broccoli. And that's pretty much what we were saying the whole time. And their performance was better. And then I think coming out of two different camps, I'll never convince anyone, none of those people, that Richard Dennis and Bill Eckhart gave us far superior systems and philosophy, but it's absolutely true. That's where we came from, which was basically trade for yourself. Maybe you'll have a few clients, but have a chip on your shoulder. Clients will always be tempting you to do the wrong thing. They don't understand. And the whole basis of what you do is it's hard to do and it's counterintuitive. And letting profits run and accepting volatility is difficult. You need to be aware that whatever lurks out there is not going to brag on you and compliment your trading strategy. It's just going to make the most amount of money and be the most robust. The other guys, they were coming out of these big trading firms that had marketing departments and were raising lots of assets. and with probably a minimum emphasis of research or trend following in general, moving average crossovers and things like that. And then we're kind of done. Now, how do we put together this organization? What is it going to look like that will attract people to give us lots of money? And so A+ for them on that. And that's why they have these big organizations and they're so much better at raising assets, because that was their main goal, was to raise those assets.
It's an important distinction for people to try to understand. Difficult, never easy. Let me shift you to something, though. I've been through your Twitter feed recently, and for people out there that have not seen Jerry's Twitter feed, if you don't want to do all kinds of interesting research to find confirmation and backing to the philosophies that Jerry's talking about, he finds it and puts it on his Twitter feed. So I feel like I don't even have to think. I can just go there and it's always there. And you had one, I want to read this and I'll let you comment on it. I think you're quoting from somebody else, but it said the big blowups are typically caused by extreme intelligence that causes people to believe their own dangerous stories that you can predict with accuracy, use leverage because your prediction must be true. I'll let you comment on that, but I think also it would be interesting too is your thought that given to where we are right now with many markets extended, especially U.S. equities, there's probably a few of those lurking out there that could get pierced sometime in the future. They're doing exactly what you're describing, but the leverage is being hidden inside of bull markets.
Yeah, that's a really good quote. I should have mentioned something about that because you asked me a question earlier. And really, I think what gets at the heart of that is how, for some people, trend following is so hard because you can add things to it. That makes it so great because it has that one rule entry, one exit rule, one stop loss, and then we're done. And I'm saying you're done. And I'm sorry, but you're going to have some drawdowns from your open trades that are going to make you uncomfortable because we like that money. It's our money. We've already spent it. They even call a drawdown in an open trade a loss now. You take these smart guys with PhDs and you tell them, okay, you're finished. Now go market or something. Like, no, I don't want to be finished. I can always improve and I need to get rid of these. This is what's standing out are these volatile periods. And so it's just very difficult for really smart people to say enough is enough and I can improve upon this and just fall in love with this back test. I mean, I think that's the worst thing going is the back test. I like to look at the trade stats, the average win, the average loss, the win percentage, win-loss ratio, and things like that. People tend to fall in love with the equity curve back test, going back to the 70s and 80s and watching how the markets go up and down and really take away some key clues from all of that, which I don't think there are any clues at all. It's to be ignored pretty much, except that if you're picking up on any risk in the future that you've seen in the past, just pretty much bank on that it's going to look worse in the future. And some of these firms would really make a big emphasis on research and change and evolving because this is what clients want to hear. But true trend following is we don't change. This is our problem, is that we're always in constant search for more and more sample size. We must include the 80s and the 90s in our trade stats. And the world has changed a lot since the 80s and 90s. Is it still okay to use all of those trades? This really baffles people and makes people very nervous to not evolve and change over time. A lot of the industry, that's their main calling card. Watch us do our research and watch us evolve and change. And that goes against classic trend following.
Well, classic trend following is taking advantage of classic human nature, which doesn't seem to change, does it?
I don't think so. And it's looking back over all of that period of time and seeing that you have these outlier trades and you're going to have this volatility and it's fine. It's not good enough for a lot of people for the computer to say to you, hey, if you risk 50 basis points per trade, these parameters are going to make the most amount of money for you. It's not good enough. Well, I need to eliminate some of those bad days and months because I'll be getting phone calls and complaints. Deep down, I think it bothers them just as much as it does the clients. They actually believe that targeting volatility and having special rules, special profits is something that they should do and want to do.
I want to keep it at you for a moment. Obviously, I think anybody that has heard you before or seen you talk, they probably think to themselves, it seems like a pretty disciplined guy. And I know you're very conscious of health, fitness, your weight, and you have been for a long time. When you speak to your kids and they want to kind of learn about your routines and your habits, how are you talking to them? I mean, I'm really curious about the Jerry Parker discipline, the Jerry Parker ethos, because you probably did not have the same ethos about physical fitness and staying in a certain way. You probably did not have that when you were younger. What has allowed you, and speak to this process of developing you?
I think practice comes to mind. That's what the secret is. We all kind of realize that you can practice piano or your basketball, but all of these disciplines can be practiced as well. I remember when I decided to get in shape, I was 40, and I had never been in shape a day of my life. And so I had no expectation, but I just started to realize that day after day, putting one foot in front of the other, you get better. You practice and you learn and you sort of figure out things that you thought were impossible or not impossible. It just gets better and easier every day. And that's that discipline. And then I was highly motivated by results. Once I started seeing results in trading or in diet and fitness, I ramped it up. I went extreme. You can even hear everything I talk about. I want to try to make it as pure and extreme as possible and kind of get to the core principle and be the one person who may be able to take it further and more in depth than maybe I should, but at least talk about it in those terms and try to see if you can't push the limits as much as possible. When you first start out, you're not thinking about anything except let's lose 5 pounds. And then as it starts coming off, I was just getting more and more excited and going, okay, we got to go for high school weight. And so I had never lost 5 pounds or 10 pounds in my life. But as you start seeing success in implementing principles and understanding the principles of what works and doesn't work, you need to start pushing yourself to extremes that you never thought you should even imagine. And so I think that's what I'm good. I can get obsessed with things very quickly, trading, diet, and fitness, but then understanding the basics, learning over time, and listening to other people and saying, okay, this is something I haven't heard before. It doesn't sound like it fits with my philosophy, but I'm going to think about this and keep it on my list of things to explore. And then maybe I'll get rid of it later or I'll incorporate it into my plan. I just feel like I was incredibly open-minded about anything people would tell me about trading or diet and fitness or any area I was interested in. I was just totally open. That's rare these days. Rich said many times that I think I could print my rules on the front page of the paper and no one would follow them. And I think he meant they were too hard to follow. Small losses, 40% win rate, let your profits run. But I think now I could print my rules on the front of the paper and everyone would just criticize them. They're too simple. You don't know what you're talking about. I studied this in college and you're not using Sharp. So I think that's the new way of looking at mentors and older people who've learned a lot, is to argue with them and disagree with them. That's fine. I don't really care. I love a good argument. I try to foment arguments all the time on Twitter and get someone criticizing my views so I can kind of learn and hone my responses.
Interesting about what you said about the practice and the experience of it. Okay, you don't know anything about fitness, you're age 40, you start to lose the weight, it comes off. And then some kind of like magical motivation happens because now you are personally experiencing it. That is very difficult to share with other people because it's the magic of experiencing it yourself. And then all of a sudden it's like, wham, bam, thank you, man. It just feels so good and you can believe in it, but it's tough to share with other people, isn't it?
It's tough. I don't think I've had very many friends or family come up to me and say, tell me your secrets. I have had people come up to me and say, write down what you did. What do you do? And I could do that in trading as well. Write down all the things you do in trading or diet and fitness or whatever. And I did that once and I looked at the list and I was just shaking my head because it's not something you want to read up front. You want to take these baby steps and figure it out for yourself. I just had a really nasty competitive streak that I could tap into once I got a glimpse of some sort of accomplishments that I had never thought was possible. It was the same thing with the turtles. I remember being obsessed with getting to 100 million. My friends were like, what's wrong with you? Why can't you just calm down and settle down? I'm like, no, 100 million. I got to get to 100 million. And so I was just extremely competitive and not happy if I was in second place or worse than second place, as far as returns or relative return. So I was really a bad loser. Oh, I'm a hugely bad loser.
Right when you said the phrase nasty competitive streak, I thought you were going to pause, and the next thing that was going to come out of my mouth was to ask you, because I could feel like the cymbal shot right there. I just wanted to say, why are you so competitive? What made you so competitive? Like it was, before you said it, I was like, oh, damn, he stole my thunder.
Oh, man, I don't know what made me so competitive. Someone asked me on Twitter yesterday, did it come easy for you to be disciplined? And I said, no, it did not. And from day one with the Turtles, I was probably the least disciplined. But in my interview with Rich, I was like, oh, I'm incredibly disciplined. Oh, yeah, we're all disciplined. We can all talk about how disciplined we will be. Right out of the gate, I was probably the least disciplined of all the Turtles, January 1984. But thankfully, I seldom got rewarded for my lack of discipline. So I was always chastised all the time, day after day. If I didn't follow my rules or my system, I could immediately almost see the downside of not following it. So I had no positive feedback. So I righted myself very quickly over the years to be better disciplined. But honestly, the amount of money that I've left on the table by not being 100% disciplined or even close to it is pretty sad. It's a sad story. We don't need to get into that.
You brought up crypto earlier. Now, for some people, the uninitiated, and I don't know what percentage of my audience is uninitiated. I go all over the rainbow in terms of topics, but you brought up crypto. And of course, if someone, and hopefully they do know about trend following, but trend following traders would know, okay, crypto, it's another market. Jerry can trade, Mike can trade, anybody can trade. And okay, Jerry's going to apply trend following principles to it. Speak to crypto. How did you make the decision? When did you make the decision that, okay, this passed the smell test for me, I'm in? And I'll let you also comment on crypto itself, because a lot of people are going to be thinking, when I'm asking you about crypto and when you're responding, that Jerry must be a crypto maven. You might be, but that really doesn't have anything to do with your trend following trading.
That's right. I mean, that's 100% right. The answer to that question is always the same for every market, any market, and that is liquidity and diversification. So obviously, it's pretty diversified. No one even understands it. I have people tell me about it. I still don't understand it. So then that makes it less susceptible to deviating from a rules-based system. So I think to some degree, it's the perfect market for trend followers. You have no clue what you should do other than following your system. Unlike all the other markets where we sort of do have a clue, we think we have a clue. But I think what happened with Bitcoin, I wasn't alone in this, is that all of us older guys who were looking at it and trying not to be left behind and having been burned so many times for being too skeptical about new ideas, we didn't know how to open up a Coinbase account. And then, oh my gosh, all of a sudden the CME comes up with the futures. Yes, I know how to trade futures. I have a lot of them in my account right now. I know where the CME is, and I can put this thing on. I think that's probably one of the reasons that the cash futures spread got out of whack, was because all the hedge funds and old guys like me were only interested in doing the futures, and we didn't even know how to set up our Coinbase. I'm skeptical of Bitcoin in a sense that I think it could be a little dangerous in these crazy sell-offs. I'm not happy with that. It doesn't look like something too different from all the other markets I trade, because there's been crazy sell-offs in everything, lumber and some of the stocks even. I've been around a long time and I've seen crazy volatility in the bonds and the British pound, for God's sake. So don't talk to me about crazy Bitcoin. It doesn't look any different, really. But I do wonder what's going to happen in the long term, because I'm really always interested in being able to exit the trade. But I probably shouldn't be, but it's definitely in my portfolio. And that's another great thing about the markets since the 80s, is the number of markets that are out there. My portfolio is so large now, over 100 markets. And so that makes me very happy. And I can take a lot of small risks in a lot of different markets, Bitcoin being one of them. And Ether pretty soon, I think. There's the futures on that. And my friends tell me it's different and it's not 100% correlated to Bitcoin. So I'll probably be adding that as well.
It is a little unusual in the sense that, at least when you started, okay, a lot of futures contracts on ags and metals and then currencies and stuff like that. I mean, Bitcoin could literally be a great trading opportunity. I'm not saying it is, but it could end up just being a scam. I mean, literally, there has to be one option on the table that it's a scam, but a scam that is got a ton of money in it and is very liquid and goes up and down and is legally traded on an exchange and is generally accepted by the public. That's okay.
Yeah, I mean, anything's possible. I definitely read a lot about it and listen to a lot of podcasts. I know it's not a currency, so that I don't care about. I'm not sure what it is. I do have sympathy for people who, like people in certain countries like Venezuela, who, if they could have put their money in Bitcoin 15 years ago, their life would be a lot better. So I do think that it is a great failsafe for crazy governments and fiat in extreme situations. But it's definitely has its own personality. It's not gold. It's not a currency. It doesn't need to be to have value. And I do think it has this. I grew up in the 70s with Milton Friedman and monetarists and printing money, none of which matters anymore, I guess, or yet. But having that algorithm with a fixed amount of Bitcoin, that is pretty funny. It's pretty appealing for a kid from the 70s, because that's what we were taught creates massive inflation, is the ability to just keep printing and printing. So I hope it stays alive. I hope it does well. And I hope it expands into more and more diverse cryptos that are complement. So we can have a fifth: currencies, commodities, stocks, bonds, crypto, 20 cryptos. That'll be fun.
Speaking of extreme markets, I want to quote one more, maybe two more from your Twitter feed. And again, I think this is you quoting somebody else, I believe. But the quote was, even if markets are in a bubble, your position should be long until your trend following exit is hit. That's all there is. That's the rule. Nobody knows what the markets will do and where prices will be tomorrow, next week, next month, or next year. That is a really tough thing for people to handle, that they might have, again, you spoke to the extreme intelligence. They might have this extreme intelligence and they have decided we are in a massive bubble situation in XYZ equities or whatnot. And they want to apply all that intelligence. But that's not the way it works. There's always going to be a person after the fact. And I'm not criticizing Michael Burry. He's a very smart guy. I love the movie. But there's always going to be somebody after a bubble bursts that's going to be there and be that person that predicted it perfectly. You can't really build a life and a trading strategy around trying to predict the one bubble that's going to happen in your lifetime.
It's almost like if you do that, it was such a rare thing and you may have been lucky that you should just walk away. I think some of those guys, some famous ones, they made a lot of money in that period, and then they ended up starting hedge funds. And from then on, the hedge funds just lost money. Maybe all you have in you is that one big trade. I think we have a bubble in bubbles. That's another quote from someone else. I may have made all my life's fortune in bubbles. And so what? I mean, who cares? The market goes further than it should. It's crazy. And we rode the trend up. I mean, maybe that's why trend following works. That's fine with me. That quote is from my two friends, Moritz and Moritz. I think that the big issue with that is something I've learned over time, and that is you can't predict the markets. Not only that, but today's market has no bearing on tomorrow's. I've been in so many situations where the market closed on its high. It made an all-time high. I was making a ton of money. It closed on its high on Friday, and man, the weekend was just so much fun. I felt so awesome about myself. I'm at equity highs, this group of markets that closed on their high. It was a strong close. And of course, that was the high, and it crashed from there. And vice versa. I limit up one day, it could be limit down the next day. You think you see these patterns and you think that it's so obvious. I cannot believe I'm waiting to the 100-day low to get out of this thing. It's so dumb. Why am I doing this? All my friends are taking profits. And then all of a sudden, the market reverses and goes back up. It's just in the cards that has to happen. To have a two-way market, to have a life where we all know prediction is impossible, you are going to win on some of those situations by just following your strategy. And you're going to win overall. If it wasn't the right thing to do, the computer would tell you, don't wait until that 100-day low or that 200-day low. But you get enough of those reversals where it keeps going and makes new highs. So I think that's the lesson. Put your trades in the morning and then don't look at them until the close.
I love what you just said about making money in bubbles. What a great quote. We need t-shirts about this. The Jerry Parker t-shirt. So what? Who cares? Like, listen, you could write a book. If you could write a book explaining the depth behind the statement, so what? Who cares? Really? I mean, you know that. You know what I'm driving on there. There's a lot of depth behind that. Most people is, oh, that's just a throwaway from Jerry. Your voice was going down. It's not even that big deal. So what? Who cares? Is a huge, huge philosophical point.
It's so funny to read what other people write about bubbles and the extended stock market. And they're so uptight about it. And they've been doing it for so many years. They've been wrong for so long. And I just sit back in my little bubble and just trend follow. And I don't really pay much attention to any of a reality. It's just what gets other people so upset and so uptight. And their idea that this is what I need to unlock. I need to unlock the secret of these bubbles. But I think when I was in my 20s, I was like, I need to unlock the secret of staying on these trends. And it just came to me that that was what I should be really concerned with, is capturing these outliers and not giving a twit about why and why they were outliers. And is it a legitimate outlier? Is it a legitimate move? I mean, to me, it's just such a waste of time. But to a lot of people, it means a great deal to them. But I don't really understand. I guess I've been a trend follower and a trend follower at heart before I learned about trend following. Yeah, that's definitely true. I definitely believed it before I knew anything about it. I was fertile soil for this incredibly magical experience that we had, the Wall Street Journal ad, and then going to Chicago and learning. I'm in my 60s, and so my memory is not as good as it used to be, but I do have a photographic memory when it comes to things that Rich and Bill said to me and said to the turtles.
By the way, I think we've talked about this before, and I'm in the process of pulling it together, but I will share a copy with you when I've got it all pulled together. I probably single-handedly have got every last thing that was ever printed or quoted about that entire Wall Street history of the turtle. I'll have to share that with you one day when I've got somebody working on it now. Who do you enjoy the most on Twitter? Do you have a couple names you want to throw out that you really like? I'm already telling people they should go follow you and check you out, but who do you really enjoy on Twitter?
Well, I enjoy Moritz Seibert and his buddy Moritz Hayden, I think, and two quants. And then I enjoy Niels. Richard Brennan is really good. Morgan Housel, I quote a lot. Mark R. from John Henry, ex-John Henry.
Oh, I'm not going to let you get away with that. I'm not going to let you get away with it. You got to say it.
Mark Rozemski, I don't know how to pronounce his name. Rob Carver. I have a lot of loyal Twitter followers and Clubhouse. I'm on Clubhouse a lot now. I get a lot from those guys as much as they get from me. And like you said, I'm just pretty much searching for something out there in the news or study that I can twist into something that benefits trend following and putting that out there and quoting other people. One thing I did want to go back to that I keep forgetting I wanted to mention, I think this is worthwhile, is that I think that it would have been a much different experience for the turtles if we would have stayed working for Rich a lot longer. In hindsight, the mentorship that we got was so important. It was more than just the rules. I've sort of used this bad analogy of here's a manual, now become a Marine. It's not possible. I mean, the manual is necessary, but you're not going to become a Marine without the boot camp. Here's the list of rules for the turtles, but getting that list from Rich and Bill and having those 4 years is indispensable. And another 4 years or 5 or 10 years would have been so much better. And I think that the legacy of the turtles would have just benefited so much in terms of trading and discipline and business. And so I think that that is something that is not to be dismissed, is that we would have been much better at our job if we'd had more time with those guys. The time that we had was indispensable for our success, not just the rules. And that's just maybe coming over and talking to us like once a month or less, but just knowing that they had your back. And navigating the markets in the 80s and the 90s with those guys would have just been a big benefit for us, for sure.
Can I push back just a second? I've already kind of laid you out as the guy that's got the endurance, the guy that's kind of like stood the test of the time from the turtle experience. But I think there would definitely be some people in the class with you, the two classes, that maybe they did really well under Rich and Bill's tutelage, but maybe they weren't cut out for it necessarily? Or do you think that if everybody would have stayed much longer, as you just theorized, that that would have helped some people that just needed more time?
Yeah, possibly. Like I said, I think going through the markets and just living with the trades and the trends and the losses, We had 4 pretty darn good years where we made a lot of money. So going through some of those bad years and maybe a losing year or two with those guys and spending more time, maybe changing the environment a little bit, like everyone leaving the office and working from home, or Virginia and Florida and New York, and then coming back together once a quarter for an update and that sort of thing. Maybe that would have been good. I think the environment, everyone being in the same room, that had not always had a hugely positive impact on people's trading and their creativity. Rich wanted some creativity from the group, and I don't think he got very much creativity and new ideas. So it could have changed a bit. Going through the tough periods with those guys, I think would have helped everyone.
Will your football team get another one this year?
Tampa is really having some good fortune. And at some point, I felt like you had to make a choice between Brady or Belichick. And I chose Belichick. Brady will be nothing without Belichick. I remember going to the Super Bowl and sitting down and going, whoa, wait a second. If he wins this thing, this is amazing. I'll never bet against the GOAT and Tom Brady. It's so much fun to be in Tampa with the Lightning and the Rays and the Buccaneers. It's a magical time. It's a great place to live. I just love sports. Do you get to see any NFL?
Yeah, I catch up. I tell you, though, I think with Brady, it's going to take a handful of years before we all appreciate how crazy it was to leave New England, go to Tampa, and pull it off in your first year. I just don't think that story gets enough credit as to how amazing from a sports perspective that is. It's just truly, it's one of a kind. I mean, that's not going to be repeated. Nothing like that. He might repeat it. He might do it again, but no one else is going to match him.
Yeah, no, he's an amazing person. No doubt about it. He is easy to root for, especially if you live in Tampa. I'm a big fan of reading books, studying successful people. And I think he's a guy who obviously has a process, and he talks about his process of being in shape and leaving nothing uncovered, paying attention to the smallest details. So he's a guy who would probably fit in with trend following because I think he loves the process, wedding himself to some basic time-tested philosophies like I do.
Jerry, everybody can find you easily on Twitter. It's always curious to me that when I want to pull your Twitter up, if I go to Google, it must be a very rare name, because if I type in Jerry Parker, you always come up 1, 2, or 3. Even though it seems like a very kind of name that's very common, Jerry Parker is very unique. It really is. It always pops up. You don't even have to give your Twitter handle. You just type in Jerry Parker, you're going to find you on Google really fast. Is there a website you want to send people to, Jerry? And also, you mentioned Clubhouse. Is that a private thing that you've got, or is it only by invite right now?
No. Clubhouse is open. We have 2,000 members. Trend Following Trading Club. I would say probably half of those are from India for some reason. So Indians, I think, like trend following and process and systematic trading, it seems like. Clubhouse is a great venue to talk about trend following trading, and ChesapeakeCapital.com, and Twitter is great.
I saw the Indian switch in my world just in the last 3 or 4 years. All of a sudden, just India's like online, into trend following, wham. Good insights. Jerry, I appreciate it. Hopefully we can talk again in the future. So far, you keep talking to me. I guess I've not done anything too wrong yet.
I really enjoy you, and I appreciate all that you've done and all your research and all your archives. And I would love to get my hands on some of those things and see this new book or project you're involved in with the turtles. So thanks for all you've done for us. And likewise, whenever I type in trend following, you come up. So that's a good thing.
Yeah, they had to change all the names of the strategy to something else, because if they kept with trend following, they were just helping me.
Thanks for having me. It's been fun.
Hey, Jerry. Thanks, man. I appreciate it.
Enjoyed it.
My guest today needs no real introduction for this particular podcast, for my trend following podcast, one of my earliest guests. He has appeared many times. He also happens to be, shall I say, the star, one of the main characters of my book, The Complete Turtle Trader. Today I welcome again Jerry Parker, President, CEO, founder of Chesapeake Capital. Jerry's early background, so unique across Wall Street. He is one of the original turtle traders. I always love talking to Jerry. He is a very, very thoughtful, pragmatic guy. I think you will appreciate his wisdom. And do also check out his Twitter feed. Jerry's Twitter feed is one of those feeds that if you're a Wall Street person, he's always finding something interesting. Oh, and one little PSA before I jump into this interview with Jerry. One little PSA. Check out my newest edition of Trend Following. 220,000 words. Get the hardcover version. Trust me. If you have any other version of Trend Following in the past 10 years, you want this edition. You just have to trust me on it. In fact, if you have any other edition, I dare you to buy the newest edition and then send me an email and tell me that it was a waste of your time. I don't think that's going to happen in any way, shape, or form. But in all seriousness, the book has been completely rewritten, expanded. It is the massive newest edition of Trend Following. With my PSA out of the way and without any further delay, nice little rhyme there, let's jump right in with Jerry Parker of Chesapeake Capital. Jerry, my first question is kind of a fun question. I just did a binge watch of the third season of Billions. Do you happen to be a fan of this show at all?
Oh, what so much fun. It's like the most popular show in a while. All my friends, we all love it. Even I don't think it has much to do. I'm not sure it has much to do with real life hedge funds, or certainly the hedge funds that I know anything about. And I find myself not always rooting for the hedge fund guy. I find myself rooting for the person who I think is going to win and dominate the other person. So sometimes I'm Paul Giamatti. I'm loving on him and watching him. Looks like he's going to crush this bad hedge fund guy. So much fun. What a great show.
I'm very envious sometimes when I watch a turn of the phrase on there, some of the writing, you just see, my gosh, the creativity is just amazing. Some of the lines, you just say, oh, I wish I wrote that. I wish I said that on Twitter, you know?
One of the great things about being in the hedge fund or trading business or having your own business is not having to shave every day and then not having to dress up. And God, that guy, the guy acts. He never wears a coat and tie. Shows up at fancy events. Maybe if it's black tie, he wears a black tie, but those T-shirts, those fancy T-shirts, what a great lifestyle he perpetuates on the TV.
Let me ask you there. I mean, you've been around occasionally some interesting events, and without naming any names, have you ever seen anybody that cavalier on the dress code?
I don't think so. I mean, I wish I was him. I wish I could pull that off. I like to wear jeans everywhere and or be a little casual. And whenever I'm in those situations, I was in one recently. I was a little nervous because I don't want to be the only one there. And then all of a sudden, a friend of mine shows up with a golf shirt and sandals. And I was so relieved, so happy.
I even appreciate it. I take it a step further. I enjoy when he puts on the heavy metal T-shirts. He'll have something like a Black Sabbath or AC/DC on or something. Takes it the extra mile. And I'm like, oh, I'm in love with the attitude. But listen, here's where I want to jump in away from Billions. I want to quote this from you. And you're kind of a fun guy to prepare for because I can basically go to your Twitter and jump inside Jerry's mind to prepare for a conversation with Jerry. That's a fair assessment, right? It's kind of what I can do.
Very fair. I think that every now and then I leave something I don't sarcastic. It's a little try to make fun of something, and I may not say, hey, I'm trying to make fun of this. So 99% of the time, yes, I think that's true.
So here's the one I want to quote you on, and you'll have to tell me if it's your original line or not. But I thought this was a great way to open up the podcast. And frankly, if we talked about this one line for an hour, I could be happy because there's a lot to break apart here. It's very subtle. It might not be subtle for those that are experienced, but I think for a large portion of the audience, it's probably pretty subtle. The line that I pulled off your Twitter feed, the final step for AI and machine learning will be to wait for the breakout. Is that yours?
It is mine. I don't know. I probably got inspiration from someone else, but that's mine.
I love that one. That's Jerry Buddha right there.
I'm proud of that one. It's a little poor English, probably, but I tried to make it succinct. Maybe it was a little too short, but I do think that what I was trying to say basically is in my experience, and I think I'm anticipating these algos that are AI or machine learning, I think they will put together some useful information, I would say, and do something that trend following doesn't even attempt to do, of course. But then the final step in that buy, sell, go short, go long. It should be, probably could be, let's just wait a couple of days or a few hours or whatever for some sort of price action, buy the high, sell the low, whatever. So let's wait for that breakout. It's a little sarcastic, and I know nothing about AI and machine learning, but I wouldn't be surprised if everything that we find and all the trend followers and CTAs find to be true about the markets, they're going to pick up on that as well. And it's nothing wrong with that. I remember reading a book, Market Wizards, and one of the guys in there is very smart and very wealthy and famous. It was in the first one. And I think he was talking about a Canadian dollar trade, and he was analyzing this trade, the fundamental analysis. And then he sort of said, yeah, it could be long, could be short. I guess I'll just wait to see which way it breaks out. And I thought, okay, I just forget that first part and I just wait for it to break out.
You're kind of getting the same place with your comment about AI and machine learning. You're taking the jargon of today, replacing fundamental analysis with AI and machine learning. Maybe not one-to-one, but essentially it's what you're doing. And then coming back and saying, ultimately, but if there's no movement, if there's no price action, then what do we got?
And it works. I remember I had some bad ideas once, counter trend type trading we were researching, and profit objectives, take profits, it goes to everybody's mind, and you research this stuff, and it doesn't have any good statistical basis to trade this way. There's not a lot of sample size if you start concentrating on large trades. So we would just write this rule that said if it's a large trade and it's gone up X%, get out, just take a profit. And of course, it looks great on the back test because the computer will go out and find that perfect spot given the historical data of where you should exit. Sharp ratio goes up. It's just perfect. My research guy came back to me once and said, you can't make it a little bit better. He said, that would be if you just waited to like 1 day lower, 5 days lower. So if you just threw in a little bit of trend on this bad idea, that increases it quite a bit because it works. Sometimes, you will get out at the high, and then sometimes you'll have another 10 or 15% to the upside before it goes to that 1 day lower, and then you can take your profit. Just the power of trend is everyone sees, everyone picks up on it. You can't have it both ways. You can't say it's really crowded and there's lots of trend followers and then not expect people who make it their living to analyze lots of data to say, hey, can I just add this little piece of trend as well? It really seems to be a great timing mechanism.
Not that I approve of this, but it reminds me of athletes of the 90s, particularly baseball, that add steroids to an average player. All of a sudden you have something nice. Add trend following to kind of an average portfolio, you all of a sudden have something nice.
Very good analogy. I love that. Trend following is steroids.
You can send the wire payment directly to me.
I like that. I get a lot of good comments from my friends who text me and email me a lot of good stuff. I always ask them, hey, can I tweet that? I will put your initials on it in quotations. And I did that yesterday. And 90% of the stuff I put out there is not mine. You just happen to find one. And yes, I really like that. So I'm really proud of that one.
Well, I love the one about the AI. And I was just thinking as you were talking about, the notion of adding in trend. And I just had this conversation with Bob Enck, who you know. And so I was just thinking this whole idea, it's like nobody wants to talk about this great thing you're adding in, but everybody knows it's a great thing to add in.
That's right. I did some research projects with a famous research outfit, mostly stocks, but currencies and bonds and commodities as well, down in Florida a few years ago. And when I went down to visit them and talk about our research projects, some of the model builders, they would build models for institutions and traders and clients. He told me the story about how he would be asked to build these models based upon fundamental data. He would say, look, if you just let me add a little bit of trend to it, it'll make it so much better. And a lot of people would say, no trend, can't have that. It's a stigma, it's something going on. I think now that some people call it momentum, and it's promoted by really smart people, momentum is not as bad a word as in trend following, I guess. Kind of the same thing.
I think maybe they just invent new words because people like you and I use the word already, so they need it's a marketing move. Hey, so here's another thing I pulled from your Twitter feed, and you were quoting somebody else who had posted it, but it was just a line from Bridgewater. And it was from, I guess, sometime probably in 2016. And the quote was, Bridgewater Associates expects a 10.4% drop in U.S. equities market should Trump win the presidency. Should Trump win the presidency? Well, of course, everyone knows that's not happened. We could break that apart for people, and some people are going to know where you're going to go with that. But I think the larger issue that I have there is I'm starting to wonder, and I see this across Twitter, when a firm is so big and so successful, it's almost like they're shielded from constructive debate or constructive criticism. Whereas if it was just some random guy making that statement, we all might have eviscerated it. But if it's Ray Dalio, and I salute his success, one of the best success stories ever, it's an interesting thing where it seems like, how do I want to say this? There's silos a little bit, or maybe my perception's completely wrong. How do you read that? You posted the tweet. You didn't say much about it, but I mean, how do you see that when you see a quote like that from one of the most successful investors of all time?
Well, I mean, I think Bridgewater's pretty amazing, and they've survived. And that right there makes me think they appreciate diversification and taking small losses. I just took that quote as irrelevant that it was from them, but more along the lines of you just need to continue to make fun of predictions and then try to, whenever you can, remember that predictions are kind of dangerous. 0.4%, that was kind of funny. It's kind of like going to a cocktail party and talking about the markets and then someone saying, well, so you must be short the S&P. And I've had this happen. I've had brokers say, so you must be short the S&P. And I was like, oh, God, no, it's in an uptrend. And I'm long. There's two ways of talking. And, there's talking and then there is trading and investing. And so it's okay to separate the two.
But you don't do that personally, that your ethos is such that, I mean, I think that's what I love about your Twitter feed is if I go there, I don't really see any subterfuge. I see this guy saying, here's how I see the markets, here's what I do, but I don't really see any kind of big pronouncements about the stock market going up 23.456%.
No. I mean, one of the things that frustrates me about the stock market in general is that it's a great trend. There's been so many people that have talked bad about it. It continues to go up, and valuations and value and predictions don't work. But it's just a trend. So let's all, if you're a trend follower, like it, get on it, make your money. I think that we have a tendency to talk about diversification and crisis alpha and adding CTAs to your portfolio. And gosh, I wish the stocks wouldn't keep going up. So that, I think, is a mistake. Stocks are wonderful. They're great. They're part of the four sectors, one of the four sectors we trade. And thankfully, we have the stocks because the other three sectors are not doing that great for a while. And I think trend following per se is not managed futures. Trend following is trend following.
Managed futures can mean a lot of things.
Usually what it means is trend following currencies, commodities, stocks, and bonds, long and short. But trend following seems to be working darn well in the stock market. So I'm going to celebrate that. It's a one little beacon of hope out there. The CTAs in general who've diversified their portfolio with currencies, commodities have been punished for that diversification. Doesn't work that well. We have a lot of short trades now, which is never a good sign. Tell me about your wonderful trades. Well, I'm short silver, gold, and copper. Oh, darn. Yeah, you're right. We're going to make all this money, and we have made money, a lot of money in the past based on long trades mostly. So I don't have a bad thing to say about being long stocks or anything that's in an uptrend and has done really well, regardless of some sort of idea about crisis alpha and hoping stocks go down so people will give me more money. That's kind of silly.
Let me break something apart that you threw out a second ago. You threw a little shade on the concept of value. And of course, if the average listener hears value, they think of Mr. Omaha, who, again, I know by no means are you attempting to insult his investment success. I know none of us would do that. There's no reason for that at all. But it's an interesting observation to make about value. Why don't you try and unpack for the audience how that might work? Because if you were a value investor, look, I'm not, but I would think that when you've had a 10-year run like we've had, what kind of style of investment could keep you in long at the top other than trend following? It seems like everything else to be saying, well, hold on, this is overvalued.
I'm not sure I'm an expert on value, but I do read a lot about the market is overvalued and it's expensive and things like that, and yet it continues to go up. So I think that's a problem. Once again, if you maybe I'm in favor of anything that's a process and has rules and a strategy, and maybe applying a little bit of trend to value might help value quite a bit. Not value plus momentum or value plus trend, which a lot of people advocate. I'm talking about add a few breakouts to your value idea, because you can't predict these markets, and the markets are irrational. I mean, it's been overvalued. I'm okay with someone saying, won't you pay attention to science here and let me show you how it's overvalued? I'm like, I'm down with that. It's just been overvalued for 5 years or whatever. Let's just make money and not try to make it an opinion contest or an intellectual contest. It's a trading competition, and adding the trend and the breakout. I'll buy these value stocks when they're at the 10-day high, the 50-day high. I don't know, and they keep going lower. You save yourself a lot of money.
See, I think you're a wise, intellectual, smart guy, but in the way that you accept price, versus where I think most people, if they're imagining what a fund manager might do in the markets, they're thinking it's kind of like Axelrod. It's like Jerry Parker's at the screen using his brilliance on a moment-by-moment basis to know every lever to pull or push or prove, or to make happen. They think that's what it is, whereas it's something different. The intellectual part in your world is coming from a different angle, in my perspective.
Well, through trial and error, mostly error, you have to acknowledge that embracing the process and the rules is where you want to be. At the heart of a lot of fascinating people and successful people, football, athletics, coaching, acting, science, whatever. It's people who have a good process and have, thankfully for me, I've strayed off the rules many times over the years, but never been rewarded for it. Not a momentary success where I could say, oh, wow, got lucky on that one. I've always been punished and pushed towards going back to following those rules. And early on when I was trading for Richard Dennis and stuff, I saw lots of opportunities, lots of people who had the same experience, that not following the rules was always a bad idea. Even if it's a so-so rules, just follow them. And I think that's the most important thing, along with being conservative and trading small. Yeah, those are the two things that I was told in 1983. The most important things: follow the rules and trade small. And every time I've gotten in trouble and really regretted it, it was violating one of those two rules or both at the same time. But yeah, that's kind of a sad situation. It's not a great story.
You don't make it sound sexy.
I'm always wondering if there's anybody out there who can do it better and do it different. Once again, I think there are people who do it different and better, but more than likely they have a good process. Just like Buffett, he has obviously a good process, good systems, good rules, sticks to them. That's kind of the key.
Hey, I know you're a huge fan of sports, and I know you like to look at the analytics of the whole thing as well. What's been most interesting to you in your reading and whatnot? What you pick the sport, you pick the player, you pick what you're interested in. One of the things I think is really interesting is in baseball, the guys that, with the way that pitchers are throwing, the shifts they're doing, and that a lot of batters are figuring out to be really aggressive on the first pitch strike. And just, crunching the numbers and seeing how this all plays out. It's fascinating what's going on in baseball. What is intriguing you these days in the field of sports analytics?
When I first went to Chicago in 1983, I, at the same time, introduced to trend following and turtles. My friends there, some of them were showing me these books by Bill James, and I was introduced to baseball analytics at the same time. It was very fascinating and fun. And of course, now Bill James works for the Red Sox and John Henry, and baseball analytics is an incredible field. I think one of the things that's really interesting to me is happening in Tampa, my hometown, one of my hometowns. Tampa's sort of playing around with no starting pitcher. That sort of a reliever starts the game. And I think that I find that I think baseball over the years has gone from pitching, quote unquote, to defense. Now, pitching is part of defense, and pitching is not the defense. So the shifts, using pitchers in situations and starting the relievers and bringing in your best pitcher in the seventh inning with the bases loaded to stop that from getting out of control versus waiting for the ninth inning. And just, it's really, you can sort of see it from the NFL point of view. I remember when Joe Gibbs inserted the nickelback the first time the fifth defensive back came on the field. People were horrified by this. Now there's this sort of shifting going on in baseball that really rubs the traditionalists the wrong way, but it's really kind of fascinating to watch baseball change as much as it possibly can. And I keep up with baseball through, I recommend this Joe Sheehan newsletter, and I recommend that you have him on your show. He's a phenomenal writer and expert on baseball analytics.
I will absolutely take you up on that bit of advice. In fact, you mentioned John Henry, who I think in a past life was one of your peers in the trading world. And I know that when John pivoted and went from the trading world to the sports world, probably some of the press kind of, maybe not say such nice things. I think in the long run, his pivot and his trend following applications in sports has been a pretty good move, hasn't it?
Yeah. I mean, John Henry's kind of a genius, and what amazing life and performance he's had and continues to have. I don't know if it's trend following in baseball. It's certainly math and numbers and Excel and analytics. But so much fun. I love that that's part of baseball. It makes me like baseball. And baseball is unique in the sense that it lends itself to this pitcher-batter event that takes place, and you can total up those numbers and kind of get a better idea of exactly what's going on. But yeah, he was fantastic in the trading. I'm sure he still trades and still watches the markets. What an amazing situation to be in, to be able to take that love of numbers and gamesmanship and winning to a major league and then the soccer level as well. Really admire that guy. He's phenomenal.
What's so awesome about it, too, is if you say, well, gosh, would baseball really be baseball without the Yankees and without the Red Sox? And one of those teams is owned and controlled by either a former or a still trend-following trader. I think that's a really fun aspect.
Over the years, when John Henry was managing money, lots of money, usually more money than everyone else, he gave a handful of speeches over the years that were just incredible. And sometimes when the industry was having big drawdowns, and the way he was able to encourage people and set people right in their thinking, kind of like now where the trend followers and CTAs don't we get some criticism for lack of performance. That's really, what it takes is someone to, regardless of performance, just to sort of say the truth, which is we play a positive expectation game. Don't give up, losing money. People dislike us right now, but let's just do the next trade and keep going. Digging up some of his old speeches, they're probably out there, and some of the things he said were such an encouragement to me over the years. Very big fan.
Let me pivot from John, and I think what I'm going to pivot to would actually represent his past trading, which was phenomenal. But this is a line that I also pulled from your Twitter feed, which I think is great. And I want you to kind of just, when you hear it, I want you to tell the college audience that's listening, what does Jerry Parker mean when he says this? The best returns in life and markets are lumpy. What does that mean? I want straight line, Mr. Parker. I don't want all of that risk. What does lumpy mean?
It's worse than lumpy. Lumpy just means that you're not going to make 1 or 2% a month. It's a lot of losses and bad periods, and then you make a bunch kind of quickly. Exactly the opposite of what people would like. It's not going to be a good Sharpe ratio. But I think I read an article recently from Morningstar, was incredibly one of the best things I've read in a while. They did some analysis of real traders, and they did some hypothetical analysis to see if the hypothetical matched the real traders, and it did. And it basically said that after 20 or 30 years of managing money, the people who finished in the top 10% or so had the worst performance over long stretches of time. So maybe a 5 to 10 year period where they were near the bottom. And then that was what was required in order to be in the top 10% after 20 or 30 years. It wasn't like it was an option, because the opposite was true. Those people who did not have a 5 or 10 year really bad period, they were not, none of those guys were in the top 10%. It's mandatory to go out there and find. Can you imagine going to your research guy and say, no, here's a system that's not lumpy, the Sharp is too high, it doesn't have extended periods of bad performance. You've got to go back to the drawing board. You've got to find a system that has bad performance that almost no one would be able to stick with. This is a requirement. It's a characteristic. It's a part of something that's good. I mean, it just gets worse and worse of what is required.
If I just had an energy meter there, that last 20 seconds of you, I could just like see your face lighting up saying, I know this to be true, and I want the audience to understand what I know.
And encourage people, that get ready. This is what's going to happen. Embrace it, like it. It's bigger than you. It's bigger than, here's a system, we've done research. Not only should you not feel bad through extended periods of bad performance, it's a marker that you're onto something. You're onto something good. And then embrace, how hard it is and how perverse it is and how you want criticism and you want people to say it's dead, trend following is dead, or whatever you're doing is not working. You've got to have that, at least in the systematic approach that in the currencies, commodities, stocks, and bonds. I know there's Bobby Axelrod's out there who, I guess he was starting to get in. One of his guys was starting to get involved with algos and stuff. But I think for the vast majority of us, embrace the pain. It's a good sign.
Let me get a big philosophical one out at you to open up. I know this is kind of in your wheelhouse. I know you've kind of talked about it some. So your governmental designation is often a CTA, commodity trading advisor, kind of a misnomer, doesn't exactly describe what you do, but hey, that's the regulatory term. Why don't you talk about the notion, though, of the traditional portfolio, the typical 60-40 stock split? Why don't you open up the thought process to CTAs perhaps bringing in-house more than their component they typically contribute, the 10% alternative component. But why don't you break this open and put on the table the idea of CTAs doing more with the traditional 60-40 split, actually the application of your techniques to those assets as well?
I really dislike the whole idea of crisis alpha. It makes no sense whatsoever. Yeah, I think it was invented by some people who don't really like CTAs. Crisis alpha, it's a bad idea. It's silly. It doesn't make any sense. In order to provide crisis alpha, we'd have to trade suboptimal systems. Would have to be really short term. We'd need to get short that S&P really quickly. Shorter term trend, at least that I know about, it doesn't work very well. I think the people who are able to add crisis alpha and make money all the time, basically, or take advantage of really short term moves, especially shorting stocks or the S&P when it breaks violently, like February. Great, great for you. I mean, you're a hero. You're amazing. You're way better than me and most of the rest of us, mere mortals. Go for it. But, I wouldn't say to add you as crisis alpha. Why, if you're that good and you're going to produce these profits on a really short-term trading idea, why bother with 60-40? Just give this guy and people like him all of your money. I mean, why would you do 60-40 if you really believed in a guy who really had a high Sharp and made money very quickly and could help your 60-40? Why not give him the vast majority or create a kind of a portfolio of these short-term guys? Why mess around with crisis alpha? It doesn't make any sense. And most of the normal long-term trend following, medium-term trend following CTAs, they themselves kind of expect 5 or 10% of a portfolio at the max. Or how much crisis alpha is that going to give you? If you really want to do something about crisis alpha, let me trade your equities with trend following. Let me trade your bonds with trend following. Let me trade your 60-40 with trend following. A long, short, using a stop loss, taking small losses and having a trailing stop. And then I'll throw in a few currencies and commodities as well, as many as you'll let me, because that'll help us with diversification and making more money because those markets are uncorrelated. But your problem, you've got a 60-40 passive long only, let's say, or whatever with your equities. Therein is your problem. You've got a dysfunctional idea, a dysfunctional portfolio with no risk control, no process, no plan except to buy and hold. And then you say to me, hey, here's 5%, crisis alpha me. What? No, I don't think I can do that. It's like going to the doctor and saying, okay, you're giving me this bad report, fix me, but I'm not going to change my bad diet. No, I mean, I'll try, I'll nibble around the edges, but trust me, let me get in there and do what's right for all of your portfolio. That's how I can add value. That's how we can add crisis alpha, by putting a trailing stop on Apple, Amazon, etc.
Can I sum this up that you just took on the role of Manny Pacquiao in his prime? You went into the ring and you threw about 30 different punches that a lot of people in your particular position might not throw. So you seem to be very comfortable with the intellectual joust here of saying, hey, let's put it all on the table. If we're trying to win and we're trying to be intellectually honest, then let's be that.
Then at some point in time, the next 50% drawdown of the S&P, which will recover after a few years and go back to new highs again, a repeat of 08 and through 18, I have no problem if that's what happens, or assuming that might happen again. People are going to say, do you want people coming up and saying, why didn't you advocate what you knew to be the truth, which is you should use a systematic approach on all of these assets? Why are you just sitting there groveling for 5 or 10% when you know better? I mean, how many long-term, wealthy, multi-billion-dollar CTA funds with PhD research staffs who can do whatever they want to do to add value to the clients, with carte blanche to create systems and portfolios in any way? I do too, and I'm not large, but how many of these guys are out there saying, we have done our analysis and we agree that we need X percent passive long only S&P or stocks in our portfolio? That's going to make things a lot better. Zero have said that.
Well, what's the fear, Jerry? What's the fear?
No, there's no fear. Their analysis of the markets does not dictate that. They have no reason not to do it. There's no fear. They could just hide it in there and say, we've looked at all these markets and all the arguments, and we too agree that we should have a large passive part in our portfolio that's going to make our overall performance better. I don't see anybody advocating that, even though they can do it and they have the resources to prove whether it's true or not. No one really believes that to be true, I think, amongst the CTAs or the hedge funds that use a systematic approach. It's not true. It's impossible to trade a systematic approach with a medium to long-term system and add in a few currencies, commodities to the stocks and bonds and have a performance as bad as 8% on average and a 50+% drawdown. It just is impossible. We can't do it.
As we kind of keep tearing this apart, let me throw at you a question that I saw you post. You said question of the day. You had two questions. They were kind of a little, I guess they're the same one essentially, but the second one really caught my eye, and I would love for you to kind of give your perspective on it, and maybe we'll tear back into what we were just talking about there also. What single sentence describes what most investors really want? Because we can talk about all the managers and whatnot, but what do investors want, and do they know what they want?
Yeah, that question was a little confusing. Didn't formulate that perfectly. I think that what people want that's a whole nother can of worms. But I guess what I was trying to get at was how would you describe what you're trying to deliver to your clients? What is your edge, and what are you trying to do? What should people kind of want? And I think for me, it was more of a risk-controlled experience like trend following will give you, without in less risk than this S&P we keep beating up on, but without any lost opportunity for profit. So I'd like a little more risk control, smaller losses and smaller drawdowns, but I don't really want to give up a great deal of upside potential. For many years, I think that's what the CTAs offered. They demonstrated that in the currencies and commodities and bonds. They ended up performing very well compared to the stocks. And that just hasn't been the case recently, where it does look like the stocks are superior markets, superior trending markets. I don't think they are. I don't think they will be in the long run, but it certainly looks like they are. I think that's the ultimate question that everybody should ask. What am I giving up if I diversify, if I go into the typical CTA portfolio with long and short currencies, long and short commodities, plus the stocks and bonds? It does look like I'm really giving up some upside potential. I appreciate maybe the extra risk control I'm getting with more diversification with shorts, small losses, but it does seem like it's awfully easy just to own a passive index and pay almost zero for that and make more money. That's really the issue, I think, is that going to continue to be the case, or are we going to revert back to the 90s and early 2000s where CTAs made more money and had less risk?
Let me go even bigger picture with you for a second. I've just got this thought that's coming to me. I think about the subject of trend following, and I say to myself, okay, give me the other strategies that are as well researched with so many available track records that one can look at for evidence going back decades. I mean, for those people that might not know about the proof that I'm talking about, it exists. Do a few searches, you can figure it out. So if we take trend following and we compare it to the something else, and let's put aside for a second Warren Buffett, let's put aside for a second Ray Dalio, two great investors with their own thing and so big that they're just almost something else. And let's put aside the Bobby Axelrods of the world, and let's put aside high frequency trading. I mean, we don't get to be in the trading room at JP Morgan, so I don't really know where that does anything for the average investor. If we have to compare trend following, excluding those four, what are the other trading strategies that match up with trend following?
That's a good question. But I think to some degree, I don't think we can rule out the possibility that trend following won't work very well. Maybe it can be torpedoed. I think the CTAs themselves will be the culprits of too much volatility targeting, indiscriminate selling, crazy large orders going in and making the markets cotton crash or cocoa crash. And so I think that the CTAs themselves, the trend followers themselves, could easily create a bad trend following experience. And maybe that's partially what's happening. But once again, in the most important, the most liquid, the most watched markets out there, the stocks, trend following is doing well. Why? Because there's been trends. We shouldn't discount the possibility that in the same way, and we have this worldview, which we love what we do and we think it's great, but in the same way, the value people are saying the same thing. Are you going to buy these high-priced stocks? You've seen that they crash. We got to stick with this. It doesn't make any sense. We'll go down fighting. We'll go down to the death with our worldview. I look at it a little bit differently than other alternatives. I look at it itself, and I say, let's break down the components. Taking small losses. Are we going to start taking big losses? Is that the key? I don't think so. Are we going to start taking small profits and not participating in the big, huge outliers? That doesn't seem right. Are we going to pay attention to things other than price only? Well, then you're kind of in discretionary land and no sample size and no back test worth looking at and being very confused because even if trend following doesn't work, we see that other things that don't pay attention to price, they don't work either. Is the key limiting our diversification? No shorts, no currencies, no commodities, stocks only. Maybe we can make 6 or 7% and have that 50% drawdown ourselves. That doesn't seem right. So I think when you break down the components of what we do, it is a lot of risk control and a lot of things that I'm just not willing to not do. If we don't make money and we shop around and we make just a very small amount, and so be it. But I'm not going to increase my risk and change my worldview of how important it is to take small losses and pay attention to price and be fully diversified and play for the outlier trade. All the components and the characteristics of what we do are non-negotiables for me. Maybe in the same way that looking at value is something that the value people are not ever going to give up on. It just makes too much sense. And then maybe we'll all just be bypassed by people who say you guys are stuck into history and you refuse to be flexible. But I've never made a claim. I've never had a home of mine catch on fire or have a major problem, a flood. But it's not even a question whether I'm going to have insurance. And it's not a question for me whether I'm going to proceed in these markets in the safest, most conservative way possible, which is trend following.
You just mentioned your worldview, and I would love for you to describe what your worldview is, but I can only imagine that a lot of your worldview has to do with, my gosh, the future is uncertain, and my gosh, I can't predict it. And that seems like a very grounded worldview. You might want to expand on those and maybe add if there's more to your worldview.
That's it. It's dangerous out there, and you can't predict. And I don't believe that stocks are superior and the go-to investment all the time. You got to pay attention to the trend and protect yourself and be humble and conservative and worried about risk. So all of the things that I talked about over the past 5 minutes, that's my worldview. And I don't see that really changing regardless of performance. And I don't know that is a smart thing, but it's just how I'm going to proceed.
Hey, let me ask you one last question, kind of really a non-trading question. I've met you for the first time a long time ago, and I'm fairly introverted myself. I would probably classify you as fairly introverted. But I know you made many speeches over the 90s and into the 2000s, but not huge amounts. But I know in the last 5 to 6 years on this podcast, other opportunities to speak to people, you have put yourself out there on the line and offered wisdom, education, a lot more. What has been your experience? How has that changed your perception of communication? Because you really have changed a significant amount, at least when it comes to Jerry communicating with people. That seems like a big change for you versus earlier in your career.
I mean, the opportunities are greater, to be on a podcast or give a speech. I have a lot of opinions, and I think, especially as it relates to trading and very specific preferences, I think trend following is so powerful that if you go with the trend and take small losses and diversify fully, then it doesn't seem to matter. All of these things we all pick up on that we just want to die on, this idea of how we're going to do our business and what we think is correct. I read a lot more than I talk, and I read a lot about traders and successful people who have very opinions just as strong as mine. And then we're all 60, 70, 80% correlated. So to some degree, I think all of these opinions that I'm very excited about making sure everyone knows how smart I am and how much I am the true trend follower and pure trend follower.
Come on now, hold on. Now there's some Jerry Parker sarcasm, because you don't do that. You are very humble about this.
It just doesn't seem to matter as long as you do the basics and the big stuff correct. There's nothing as important as trading, all the markets or all the good liquid markets. When you get a hold of these trends and you're just simply on the trend and you're making money, there is no system, there's no entry exit, there's no filter that is going to help you if you didn't catch that trend. Simply, I just did it, didn't feel like it, didn't like it, but I did the trade, and then there you go. And then when you don't do it, you sit back with all your computers and your intelligence and say, oh, darn, I guess the markets are kind of more important than almost anything else.
So cool that you got a chance to be exposed to that so early in life, huh?
Oh, I mean, it's, what an experience. I mean, it was the smartest people, some of the smartest people on the planet, nicest, kindest, taught us everything we needed to know, put us in a room by ourselves, sink or swim, but with a totally pretend environment, in a sense that here's your money to manage, and it's kind of all you have to do is do the trades the way that we've taught you to do them. If performance is not good, so be it. Who cares? These are our systems. We love them. They're great. You do what we tell you to do, at least philosophically. And if you do well by not following the systems, you're going to be in big trouble. And then if you lose money, well, we may give you some more money in your account. And so then when you get out 4 years later to the real world, this is not how clients act. It's so being in that environment, at least in the early years, and having that kind of encouragement, it's kind of like, well, here's nothing against teaching people to trade, but it is a unique experience to be there with someone like Richard Dennis and Bill Eckhart. It's just can't be replicated. You can't read a book and be a Marine. You can't read a book or read some lessons. It's not going to be as good as being there with the creator, the author.
You can say that confidently because there was only a small number of you there.
Exactly.
There wasn't thousands. Maybe we'll save this for the next conversation. It is an interesting point because, I started with tearing apart your world. And then it was like all of a sudden like, well, hold on. Who is this guy over here who ended up buying a baseball team? Who is this guy over here that ended up making an Ayn Rand movie? All these other traders that were unaffiliated with you guys that were doing something similar. So it's just, trend following is an amazing story. It's there are so many different ways you can go down the path. And look, there's big guys out there right now from the University of Chicago that are trading these concepts. So it's really an amazing, tough strategy to kill.
Yes. The importance of understanding that good luck and bad luck over long periods of time can make it look like you're wonderful or you're horrible and things stopped working. But to some degree, it's why it works is because it doesn't work as often as we'd all like it to. And we all have an inaccurate concept of what long-term is when it's time to sort of give up. There was a fascinating article yesterday in read from Mark Hulbert, from 30 years has evaluated stock market newsletters, and grab that. It's really interesting. I tweeted 10 or 15 paragraphs from that yesterday. It was quite amazing that he learned those same lessons, that the most important thing was a process and sticking to it. And I think that whenever I tweet things, I get maybe 5 responses or 5 likes. And I'm like, this is just amazing. This is an incredible insight. 5 people will like it. But every now and then, I will tweet something that basically has that same message. You can do it. Stick to it. You're a normal person, but follow the trend and diversify. And I'll get 50 to 100 likes. That's what people are craving.
I'm sure you've seen this, but one of the reasons I think that happens, and I see it in my world too, is we might have a follower who's got a big following and a big engaged following. And then when they do a retweet, then boom, that takes off. Social media, oh my God, it's going to kill us all.
Yeah, I don't understand it.
Seriously. Hey, Jerry, the best place for people to check you out, Chesapeake Capital. Is there anywhere else? Is there anything you would like to tell people about in terms of what's going on in the business side of your world right now?
Our funds are growing, and I think trend following is still viable. Check out ChesapeakeCapital.com and RJ Parker Jr. 09 on Twitter. Stay out of trouble with the regulators. That's probably all I should say.
Jerry Parker, so understated. Trend following is still viable. I don't know where you can put that tattoo across your chest or something. Trend following is still viable. Jerry, I appreciate you taking the time today.
Michael, thank you very much. It's always a pleasure.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.